If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show. Good morning, everybody. Welcome back to another live stream. Just making sure we are good. Streaming now to a bunch of different platforms. So I always just check to make sure everything started successfully, but it looks like we're good. So today we have a CPI report coming out. Probably one of the more important economic, well, definitely one of the more important economic data points to watch right now. We are already on edge about inflation due to the uncertainties going on with the Middle East. There has been further developments over there. Of course, every day we're getting new headlines, and it's certainly a difficult circumstance going on. And the chart that we've been watching a lot has obviously been oil. Excuse me. And so, with inflation front and center today, the question is this geopolitical conflict going on in the Middle East, where we are seeing now many countries getting involved, if that persists, then it is very likely that inflation will be impacted negatively, in the sense that higher oil prices cause a spike in all prices. What people have been talking about a lot with oil, and I thought this was kind of a very interesting point, is that it's not just the price that matters. It's the duration at which we stay above certain price levels. So with oil going to levels that we see right now, if we zoom out on a weekly chart, you can see there's something really critical to point out about this. We've had a really good couple years in risk assets. Noticeably, what has happened during that time? Oil has steadily declined. We've had, generally speaking, a pretty good development on inflation over the last few years. However, if we are to see suspended oil prices reversing course on this, is it possible that this does economic hurt to the global economy, spikes inflation, and again, the gas pump is a super painful indicator for people, right? The average person, if you go, I don't know, what can you guys comment? Like, what does it usually cost you to fill up your gas tank? I think in recent months, for me, I want to say around $45. That's how much it cost me to fill up my gas tank. And so imagine if, let's say the average person fills up their gas tank one time per week, and you times that by 4. Let's call it $180. Quick math would be 200. Let's call it $180, right? I'm spending $180 per month. Well, after you get done with paying your taxes, paying your rent, paying for groceries, $180 is a meaningful chunk of your expense. But what if that number goes from 180, let's say it doubles to 360? The average person doesn't have an extra $200 just to throw at gasoline, And if they do, if they're forced to do that, what are they going to do? Oh, they're going to hold back on they're not going to go to a restaurant this week. Like this weekend, they're not going to go to the restaurant. They're going to, instead of doing giving for some birthday, we're gonna write each other a note or something. You know what I mean? Like there's gonna be something where that missing money is going to come out of. Now, what that does is that's economic slowdown. Remember, the economy spins when everybody is spending, right? So the economy keeps moving when people are spending money and they're out and they're, buying the latest Xbox, or they're going to see movies, or they're buying, I don't know, a new car, or they're, making a down payment on a house. Those are the things that keep the economy moving. But if something as simple as a spike in gasoline makes it so that psychologically it is way more painful to go spend money on leisure activities, that can significantly impact the economy. I mean, I just gave you a quick example with me personally, spending $180 or so a month on gas, probably a little less than that. But, think about this. I drive a Jeep, and I don't, to be completely fair, I actually don't drive that much. We work in office 3 days a week. My drive's about 30 minutes. So I'm sure a lot of people have much more. In the US, by the way, 30-minute commute is nothing. I know in other parts of the world that might sound crazy, but in the US, we be driving, okay? We be driving. It's the same thing when you guys make fun of us for not being world travelers. I am blessed enough to have traveled a lot of places internationally, but also the US is freaking huge. So we've traveled a lot. It's just our country is ginormous. Anyways, let's get off that subject because I got to talk about CPI. So today's CPI report, all that to say, inflation is under a microscope, right? $45 is so cheap compared to my country, which is already double. So I drive a Jeep, so it's not like a huge, beefy vehicle. When I fill up my truck's more like 65, 70. So I won't be driving the truck for a little bit. Save myself that extra $70 or whatever. But anyways, the dollar index, taking a look here, this one is set to potentially move one way or the other. We are sitting at a major level of resistance. If you get today, let's do a quick breakdown on CPI and what we could potentially expect. So no one here knows what the CPI print is going to be. People will always have guesses. You'll have your hunch. You'll have, people who say like, oh, sell gold or buy gold, or, they'll have those like last minute. But I'm going to tell you right now, I don't know where CPI is going to go. Nobody knows with certainty, but I'll tell you what the forecasts are from some of the smartest people on Wall Street. The forecast is 2.4%. So I don't try and beat their forecast, because their forecast, they're using mathematical models to try and forecast what CPI is going to be. Doesn't mean that they're always going to be right. In fact, they're often off, because this stuff is very difficult to predict. That being said, I recognize they are smarter than me at trying to predict what the consumer price index. I mean, you have floors of, intelligent computer scientists, JP Morgan and Goldman Sachs and all those Wall Street big guys. They are paying tons of money to try and get the best possible prediction on what CPI is going to be. So that is where we get that forecast. 2.4% is the expectation. What matters to markets today, guys, is not if we hit 2.4%, it'll be sort of all right, we had 2.4%. What would be more meaningful, what was going to cause things to move, or what's going to cause things to move dramatically, is if you get a higher than expected CPI, let's say a 2.5 or a 2.6, or a lower than expected CPI, 2.3, 2.2. You get those types of readings, that will have significant impact on the charts. So for example, if we get back to the technical chart here for a second, let's talk about the dollar index. If CPI comes in higher than expected, let's say we have inflation that is above estimates, 2.4% is what we are expecting, right? So let's say expected, and then what we actually get, let's say we get 2.6. If we got 2.6 into an environment in which we already have oil on the rise, which is forward-looking, likely to cause CPI to go up, right? Again, these new forecasts are going to be higher because oil prices are elevated and for now staying there. 2.6%, let's say, for example, that's very bullish for the dollar. You can take that with you and extrapolate that across whatever chart you trade. If you trade gold, is a 2.6% reading good or bad for gold? bad, right? Because higher dollar, stronger dollar, higher inflation means the Fed will be unlikely to cut interest rates as many times this year as we had previously thought. That sends gold lower. It also sends stocks lower, right? Most likely. You do not want to see hot CPI today. Hot implying higher than expected CPI, 2.6%, 2.5%. These would be unwelcomed numbers. They would be a cautionary tale to stocks in an environment in which we just had a really bad jobs report. If we also have a bad CPI print, that could be tricky. That could cause, the stock market to slide lower here. Of course, the number one thing driving this market, though, right now is oil, because this is more forward-looking than CPI. CPI today, we're going to be looking back on February of this year and looking at the data there, where a lot of the drama has actually happened in March, right? The huge spike in oil, all that stuff that's happened in March. We won't get March's data until April, right? That's how the CPI works. It's looking at the previous month's data. So today's number does matter because it sets us up into what kind of inflation were we worried about or working with going into this. If you had a 2.6% reading over here, right, the CPI could be on its way to 3%. And that is exactly opposite of what the Federal Reserve has been wanting. They want the CPI number to go down to 2%. So if we are getting further away from our target, guess what the Fed will have to do? The Fed will, at the very least, hold off on cutting rates, but at the very worst, could start talking about the possibility of the next move from the Federal Reserve being a rate hike if things stay inflationary for too long. These are the sorts of things that could get the dollar to continue to move higher. We are talking about a long-term level of support that, at least for now, is holding. We'll see how things play out. If you are a long-term bull on the dollar index, your level to watch would be a break back above the 100 with some conviction. If you get this type of move in the coming weeks, that could be troublesome. And this, I would say, what's going to get you there or keep you there is actually an escalation of the war, right? Because at the end of the day, that is the most volatile thing in this market right now. And the market loves a good story, right? Not to say that that is a good story in any way, but rather that it likes to glom onto a current event and a story that is happening right now. And the markets are mostly listening to what is going on between the US, Israel, and Iran, and what Trump has to say about it. So we'll see how it all plays out. But the CPI does matter. It is going to be factored into our calculus of things. Let's go ahead and switch over here to our all markets view. We got about 30 seconds before the CPI print releases. What I've done here for you guys on the screen is you've got stocks here. You've got Bitcoin here, gold here, silver here, dollar index here, oil. We'll have everything on the screen so we can react to the price movements of all of our different major markets. And of course, we'll also discuss the number. Don't go anywhere after the break or after the release, because we have to actually talk about what this means for markets. We got about 5 seconds to go. Let's see what we've got. Okay, initially dollar index is unchanged. So far, not a big reaction. If it is out, I'm going to guess that came in line with expectations. 2.4%. Ivan's got us on the dot. So 2.4%. So the market did not move very much because, again, price or expectations are being hit exactly. Core is at 2.5%. Okay, so core was a little higher than expected. Headline CPI. Remember we said that the market moves based on surprises, right? It's not going to move a lot usually if the number comes in line with expectations. I think we have a double effect here with the CPI print today because the market is what we just got done discussing. This CPI is for February. February's data is kind of uninteresting to the market in comparison to what March will look like. Why? March had all of the oil spikes in it, right? All of the major blowouts in oil price, all of the geopolitical conflict going wild happened in March. And so March, the CPI for March, which will release early April, That's going to be where you really get interested in stuff. That being said, the overall market's reaction here, let's just take a quick look at the dollar index. Mostly firm here. Core CPI, as pointed out by our friend Ivan in the chat, points out that it was at 2.5%. So again, we are still sitting with a situation in which you have an uncertainty going on with the Middle East, which could be a persistent inflationary force. Take that with you. I mean, at the end of the day, that is what this is if you continue to see, and I'm, we're still seeing stocks hold up decently well. But yesterday I talked about my bearish thesis on the Dow Jones following the Trump commentary. And basically what took place is kind of what I was thinking we could see. Essentially, the U.S. President Trump basically said that in his definition that he thinks that the war is close to over, that he pretty much thinks they won. And again, by his own definition, he can say that. He can kind of create his own definition of that. Hey, that's what I would do if I was the president. Just claim a victory. It looks good for you. However, here's the thing. Iran responded with basically, no, we're not taking a peace treaty. They essentially do not want the conflict to end. And this is what I did yesterday. I talked about this on my Instagram. We got Chris Pulver here in just a second to join us on this call. We'll go ahead and bring him in on this. But check this out. Yesterday, I made the point that a prolonged conflict is in Iran's favor, whereas a short conflict is in favor of the U.S. Simply put, Iran knows that it cannot win in an all-out military conflict with the United States and NATO allies who are all moving in. They know that. The bigger idea, at least what it seems like the play is to put political pressure and inflationary pressure on the West in response to what is going on. If they can drag out the war, which is their main play, that's why we keep seeing Trump say war's over or war's about to be over. And of course, the administration, they want that. Whereas Iran is like, no, we're putting mines in the Strait of Hormuz. So again, you have one side that wants a short conflict, the other that wants a prolonged one, and both are kind of jawboning the other to probably try and ultimately get to the negotiation table. I imagine we'll probably see that at some point. But here in the now, there was a rejection from the Iranians in terms of, all right, let's do that peace talk. Hey, Chris, sorry for dropping a nice warm 8:30 a.m. geopolitics banter in front of you. But
good, man.
Kind of catch what I was thinking there. What does it make sense? Again, we are not by any means the experts on geopolitics in the Middle East, and I don't want to come across that way. But I'm just saying, generally, it seems like the political pressure and inflationary pressure, that's the only angle that Iran really wants out of this.
True. I think there's bigger forces at play with this push. I watched an interesting segment yesterday that this is basically a 30-year plan. There's a lot of different angles to this, but I think that for Trump, I mean, we clearly saw last week with comments, it was last week, the comments, wasn't it? It's like Wednesday. Did this happen Monday? I think this happened Monday, where he's basically claiming victory and taking a victory lap to pump the market up. I have never seen one person have so much power and influence over the market with what he is saying or tweeting or whatever. But I think in the U.S., the optics, the U.S. just want to see like this is targeted, this is concise, this is going to be over with. We're doing everything we want to do. This is all according to our plan.
Sure.
And obviously the longer this escalates and drags, the more uncertainty there's oil prices. But I mean, higher oil prices will ultimately hurt China more than it hurts the U.S. Did you see the $300 billion deal that's going on with Texas? Partners in India, like this huge refinery being thrown up in Texas for more supply. So I mean, the Middle East has always kind of operated like a cartel with supply and demand, which is when prices are low, they will cut production and try to boost up prices, and this is kind of the extreme of doing that. But I think that ultimately oil settles back in. That might be putting in like the top of the year. I actually wouldn't be super surprised if that's the top of the year. That doesn't mean that I want to play oil. I feel like that's exactly why I don't like trading oil, because one type of random 1 week event is enough to make all trading difficult unless you're long, right? Unless you were long oil and riding that trade. But it's like, as far as just like standard, I like to trade oil. It's like there was nothing happening for months on oil, and all of a sudden it moves 70%. So anyway, geopolitics, will continue to play out. I think that you clearly see the scorecard for Trump again and again and again. I mean, right now, Nick, we can put a scorecard that, okay, the Trump puts around 6%. 6 to 10% is like, I think that's going to be the pain point for Trump to try to spin the narrative, get Besson on calls, or get him in the media rounds, get Trump to say stuff on Truth Social, and just try to keep things like pumping along. Like, there's so much good, there's good. Let's brag about how much good we're doing.
Sure.
And that way the markets continue to churn, and it's not really doing a lot of damage as far as the overall indexes go for the scorecard.
Yep. Also, real quick, I noticed that I missed this. Apologies. I don't usually miss a donation. Thank you so much.
Nice.
Says, get a Pepsi, Nick. Thank you so much. Appreciate you. Thank you very much for the donation. But that, all donations, as we always say, they go towards the coffee fund here. Although I do like, if I was to choose, Chris, really important question for you. Coke or Pepsi? If you had to choose one, you could never drink the other for the rest of your life. Which one are you choosing?
That's a good question. I don't know. I if I had to take a cola, I'd go Coke Zero. It's probably
my man. Same thing. Awesome. Yeah, right. Yeah, Chris, we've got VIX in terms of where that's at. That has come down quite a bit. Though I did do some sell puts on the SPY. We talked a little bit about that.
Okay.
That has seemingly been an okay play. Chris, you have big three things that I keep seeing people spin around in terms of this market's current worries. And maybe once these things roll away, or even just one of these roll away, maybe we have a little bit more upside in the stock market. But here's the big three. The big three is obviously the spike in oil and Iran situation. And then the second one is the private credit world concerns. That's a big one. And then, of course, software. Which one do you think is the most valid fear in this market right now? Which one would you say?
Man. Software is probably still vulnerable. I'm seeing more and more releases. I think Anthropic was releasing all the industries that will be affected. And, it looks like, anything management, financials, healthcare, anything kind of white collar related could be replaceable, or, there's AI observation, and then there's like AI automation replacement. It does make the software space, I don't know if it's necessarily done and over with. The market's treating it like these companies are going to go bankrupt, but the disruption is very real. And I don't think that the market is done kind of throwing these to the wolves. So if anybody got the short-term pop on IGV, I think that might be about it. If you're lucky, you get a low to high, higher low, higher high follow through, but I would be cautious coming up to this trend line resistance and maybe filling a gap around like $90 to $95. That probably heads back down for a bigger trough. But I think in the short term, good opportunity from 75 to 85 or so. If you're selling puts out of the money, not a bad play. I would still be somewhat bullish on almost everything in the markets going into September, October. I think things get a little bit dicier later this year with midterms, especially if there's a big swing between House and Senate, what the U.S. takes or loses. Yeah, man, I think software is probably the most disrupted in the story, and then everything else to me is noise. I think AI is a big deal. They're going to continue to pump the narrative. One thing you and I've talked about, and I don't know the timing of this, but when do investors feel like the CapEx spending is too much and there's not enough return on investment? Like right now, I think the reason the market has not gone up to new all-time highs is because you don't have the top 10 stocks going with it. So if you look at your MAG 7, for example, let's go to MAGs here. Oracle had a big pop on earnings last night. So Apple is still down off the highs. Let's just go down the list here. So there's MAGs. Here's Apple. Here's Amazon. Here's Broadcom. Google's decently off the highs after kind of dethroning NVIDIA there for a moment. Meta's still way off the highs. Microsoft's still way off the highs. Netflix had a nice little pop. That's not MAG 7, obviously. But NVIDIA, just an absolute nothing fest. We're talking December to now. It's like NVIDIA is doing the same thing the S&P is doing, churning, nothing. I think there's a decent bid on NVIDIA, but I don't think you can have the S&P go to all-time highs without having the top 10 at least try to show some ups, because 490 stocks is showing rotation, but it's not necessarily enough market cap to drive the market cap weighted indexes higher.
Yep. Well, Chris, I've got a couple of charts I wanted to share because,
Yeah.
again, to that point that you just made about software names, about the Mag 7, about the S&P 500, the markets as a whole. One of the bigger kind of problems that we have in this is, of course, the 10-year yield that has been stubbornly on the rise here once more. And the reason I bring this up is because when we have this whole, for those who are not familiar, there's like this big sell-off going on in private equity world, private, all that stuff where people are investing in the private markets. There's been a lot of concerns around some of the big players in that space, and liquidity around it, et cetera. A lot of people rushing for the exits kind of thing. And so we see a lot of those types of stocks getting crushed. And part of the reason I would say that you have a lot of trouble in the equities world as well as the private equity world is stubbornly high interest rate yields, or interest yields. We had kind of going into this year, the playbook was the Fed's going to cut a couple of times, and it should be a nice tailwind for a continuation of the bull market that we've had the last few years. But as soon as, right, you've had all these narratives around OAI disruption, I don't think it's coincidental that those things are taking place in lockstep with a little bit of stubbornness on yields moving higher here. I think that, you look at this and you say, okay, you have oil jumping. That's going to be an inflationary pressure, at least in the short run. It's going to keep the Fed on hold, especially if this conflict draws out. If you get a breakout in the 10-year yield higher, if bonds get sold, yields go higher, to me, it's really hard to see the stock market rocketing through the highs, especially just given the list of headwinds that we now have geopolitically, et cetera. We'll have to continue watching this. Another thing I wanted to point out is, guys, we just tagged on almost every single, in fact, I think every single major US index tagged its 200-day standard moving average, simple moving average. And what we can see is that we did get a very sharp reaction initially here. It seems like there was a strong attempt from the bulls right at that, level of support, as well as this 200-day moving average, that 6,600 level on SPX. Nasdaq, same thing. Take a look at how clean we had a price reaction to the 200-day moving average on all of our major indexes, including the Russell. You had everything tap that 200-day moving average and a sharp reaction to the upside. Now, I bring this up because, again, we had a very strong initial push, but then yesterday's intraday fade showed how jittery this market, in my opinion, still is. And so when we look at this, we say, okay, we've now, tapped longer term support, but now we're coming back into this range we've been stuck into. And if we start to react negatively to this area from a price action perspective, this very well could be a continuation of this lower high series that we've been recently seeing. If you start taking out yesterday's lows, and the big one I would say to watch from a bearish momentum perspective would be if you actually take back down underneath that 200-day moving average. We got the initial snap buy off of the 200-day moving average. It was aggressive. The question is, where's the follow through? So I think we're at kind of a pivotal spot. If you're watching SPX, I'd say if you actually get a break back above like 6,900, you're starting to look really good in terms of a constructive bottoming. That's going to probably have to coincide with oil prices continuing to come down and escalation on the war subsiding. But from the bearish perspective, if you're watching this from a continuation to the downside move, watch a break below 6,600, in which case I think we could have continued downside. I do remain just slightly pessimistic on this market here in the short term, Chris. I do have a small short position on the Dow Jones. I discussed that with you over DMs yesterday, but I've got a small short on this. I also have some premiums sold, so I'm not like outright incredibly bearish on it. But I've sold some cash secured puts out of the money on the S&P, and I have a short position active on the Dow Jones. So we'll see where it takes us.
Yeah, the just to comment on the private equity side. I mean, I know it has maybe echoes of 2008, but I do think that banks are bigger, more solvent with a backstop to prevent the chaos. I know we've had Tricolor, Blue Owl. There was I think it was a European real estate company. Like these will continue to happen, but ultimately, I think that these will be absorbed by a bigger, stronger, more robust banking system. 15 plus years later, that has learned to kind of absorb the cockroaches and the bad actors type thing. So the downside is when you see a big name like, I think it was Blackstone or BlackRock, I'm not sure, it might have been BlackRock, Blackstone, one of the two. But they basically were getting about 9.5% redemptions and 9.3% redemptions. They said they were only going to allow 5%, so they essentially cut it in half. That's where people are getting a little antsy, is because you're being told you can't get your money out, which is never a good sign. And so people just continue to pile up those redemptions. But what it really is it's the refinancing. It's the debt rolling over. And right now it's just obviously 3, 4, 5 times more expensive. I mean, if you had loans during COVID for sub 1% and now everything's 5, 6%, that's a big difference as far as your cash runway and your ability to, keep the debt wheels greased. So sure. There will continue to be stories that do that, but I do think that our global financial system and the U.S. banking system is still solvent enough, and the Fed as well. It's like there's going to be backstops in there. Again, that's a terrible thing to assume, but I think we'd have to have really, really critical like high yield credit spreads and everything would have to widen so dramatically that it would be a credit type event. And I think right now that's still pretty contained. So that's why you and I are talking offline. It's like, comparing, HYG and LQD and I think it's IVI. Those three, it's like I'm watching the 2 and the 10-year to see how many basis points we have between them. I mean, right now it's like 0.55% between the 10-year and the 2-year. So until that starts to get up to like 200, 300 basis points on the disinverted yield curve, we haven't really seen historical recessions kick in. On top of that, I don't think we have a recession without, something obviously happening. And to the market side, we also said this a lot. This could be the type of, recession that is felt by either a Main Street recession that drags the markets down, or the markets fall and that drags everything down into an official recession because of the wealth effect. But if we stay resilient, I mean, honestly, I think to me, as long as the market stays, and this is giving the market a lot of props here, but if the S&P can stay above, 60, 100, let's say, I'm still pretty bullish overall. I've got a couple trades running. Like I've got a breakout measurement at 65.50. I've got some butterfly spreads thinking we might revisit that this week. But that 200-day moving average was a strong bounce. We're still not convincingly. I mean, today's interesting day with CPI. If there's a convincing move to the upside, we're back to like, let's say 68.50 or 6900. Then it's just more noise, man. It's more noise. But if we're going to go back and revisit the lows from Sunday to Monday's open, then the bears are, getting a little bit of an upper hand for this near-term trade. And I think maybe there's a breakdown to like 65.50. If that breaks and we measure the move again and we go down to maybe 6,200, that is a healthy correction for the market to offer up, cool off some of the speculation, some of the frothiness in the bull market. And all of a sudden we're talking about a decent correction that's been organized, not just like, oh my gosh, look at that one candle that's down. It's like, this has taken months to play out. And if we work our way down 10%, I feel like that's a healthy cool off in the market, so we can actually position for, another ramp back to all-time highs. So just my thoughts.
Chris, another chart that I'm watching here, of course, has been the dollar. Dollar continues to be looking pretty strong here, despite the pit stop that we've had here around 99.5. We continue to have seen resistance being met here, at least in the here and now. Dollar index is kind of benefiting from two sides of things right now. It would be, of course, the central bank pause on interest rate cuts that is likely going to happen if you continue to see oil stay elevated. Today's inflation number, it wasn't bad, but it also wasn't good, right? You kind of wanted to see a good CPI print, given that we know March's data is probably going to be ticking higher due to the elevated oil prices. It's well known that a elevated oil price or a rising oil price causes a pretty quick move in terms of prices responding, because naturally, immediately, if you're somewhere in the supply chain and down the supply chain from you, they just rose the price of transportation or energy costs, etc. You're going to raise your prices to not let your profit margins narrow for your investors or for your owners. So it happens pretty quick, and so we could see that as soon as the next CPI report. So dollar index continues to stay bid here. You are seeing, at least for now, some support forming here around this 98.6 level, let's call it. I think your next spot to watch if you're watching the dollar index is really a solid breakthrough with this level in mind, this 99.4 level. If we can get above that with some conviction, if you get this kind of move, if we can stay above there, it's very possible you could get the 100 move and perhaps beyond, which would bring us back to a longer term range. We've talked about this range for I don't know how many months at this point now, but we have really been stuck in a range for quite some time on the dollar index. Another thing that I've made this point many times on, the big, huge sell-off that we saw last year with the tariffs, uncertainty around U.S. trade. Look, the Supreme Court's rulings, I know that's old data or old news now, but generally speaking, I still think that that's kind of a supportive thing in the sense that it kind of caps just how easy it's going to be for the White House to enact, trade disrupting tariffs. And so if that is the case, then the dollar could also benefit from that, hey, trust factor for the US could go up internationally if the idea is, well, there is checks and balances in play, trade can't get changed that quickly, etc. That checks and balances is historically something that investors like, right? They like the checks and balances of, a balanced government to an extent, rather than just sort of the ability to throw changes around like crazy from one person. So I think that there's still that case for dollar upside, reversing some of the effects of the dramatic sell-off that we saw in response to tariffs in the dollar. So I'll continue to watch it, but that is kind of my thought process on the dollar. That does also keep me a little bit cautious on gold. It's been a sleepy chart here, but to the credit of gold bulls out there, understand that, people have been like, hey, why isn't gold going up a lot more? We've talked about that a bunch, but at least gold is not going down a whole bunch.
Right.
Yes, interest rate expectations are worsening for gold, but the geopolitical uncertainty is a positive for gold. So I think the net result has been gold has been choppy. And I wouldn't be surprised if it remains choppy throughout for a little while. But yeah, just a thought from me is I think the strong dollar is kind of a deterrent for gold price, but you still have to give it credit in the sense that it's not getting, we talked about 200-day moving averages getting hit for indices. Gold is still very far from it.
I know, and I'm still patient. That's why I put in the position I posted yesterday for pulver alerts. My break-even price is below current prices. I'm going out to 2028. I'm pretty confident that we could at least get gold to try to get back to these highs, if not higher. If we do, and the one thing too, it's like I did it with defined risk. I obviously want to be scaling back into gold levels, at this 200-day moving average. But if we end up having some type of play out where a lot of times high volatility, I call this the tuning fork, which is you have this huge parabolic type move and then a crash, and then it just kind of does this for months and months and months, and we get this wedge formation. Now, obviously there's bulls and bears to this wedge, and they're like, no, the bulls, because we got there from a bullish trade, so it's going to continue. The bears are like, no, that's the top, and it's going to continue to go down to symmetry, blah, blah, blah. Anyway, I don't know what's going to happen. But like I said, do I think that the governments around the world with fiscal policy running deficits hot and printing money will continue? Yes. Do I think that we have fear and uncertainty in the world? Yes. So gold is still a good play. So I thought, well, 2020, it's a pretty good time. Risking a couple $1,000s, but it's a 2-to-1 reward to risk. And obviously, if I can get a better position where I can buy at trades that I want, then obviously here I'm not worried about the timeline. I will take that into the long term as far as positioning. Sure. But for right now, if we have a year, we're seeing targets of gold into the spot gold at 6,300, 6,500 this year. Well, if we hit that, Nick, we might not pull back to my 200-day moving average. We might go to 5,800, 6,000 before we end up putting in more of a topping pad. I don't know, but I'd watch it. I just think that all of the excitement of scalping gold and getting crazy, 3, 4, 5, 10% swings, I think that is clearly cooled off a little bit. So this is probably more of like what normal trading has felt like versus all the speculation and mania that had gold in everyone's, in everyone's radar for a couple months as well as silver. So
what are your thoughts on silver?
Same. I did the same thing. I went up to 2028 in both gold and silver. My goal is as long as I can build a position where my break even is around like 60 or 50. I've got a lot of puts and ratio spreads down below the $50 handle. Couple things like I said, I think high oil prices, high silver prices are going to cause some trouble somewhere. And I think there's, they raise margins 3 times in order to kind of stop the mania, and they probably price some people out. And as speculation gets priced out, and especially on a move like this where it's kind of margin calls, non-leveraged big pockets will come in and scoop it up for pennies on the dollar, which they certainly did with that type of correction. So, I mean, if silver builds back a base around like $65 or $50, I really don't know on silver, because I feel like, yes, it'd be exciting to see silver revisit 120, but because it's the industrial side, I feel like, is this a price like inelastic asset? Is this now like strategic metal? It doesn't matter what the price of silver is because we still need it anyway. Same thing with copper. Or is it, yeah, we can't have silver at $120. We need it to be down to like $50 or $40. Yeah. And maybe it's forcefully suppressed. So it's a calculated risk. I still not mind having either in the portfolio. I mean, the reason I bought silver the last 3-4 years is because we had such a long history of not being at $50, or we're trading at 20. I thought that was a good trade. So if we have a, let's say a 12-month period where we're back down to $50 and we have all-time highs at 120, I still think that's an interesting trade to maybe get that back to 120 again. I don't think that price point is going to be forever unhit. It's like we've been there before. If there's a need, if there's a use case for it and a strategic case for it, I think silver can still get up those all-time highs again.
Yep. And Chris, I want to just, while we're talking metals here, I know we keep jumping between the dollar and metals, but we did get some updates, of course, within the scorecard here for US dollar. Now getting a bullish reading, and it is the inflation category that is most acting as a tailwind, at least in Edgefinder's scorecard here, for the dollar. It's a tailwind in the sense that, look, we have had pretty much all of our inflation metrics have tilted in favor of rates remaining elevated. So if we take a look at the PCE number, this came in higher than expected. The producer price index, or PPI, year over year came in higher than expected. The CPI today came in line with expectations, but that's certainly not helping the case, right? Again, we have what we know is around the corner. Oil prices are up. They are likely, at least in the here and now, to remain elevated and inflationary. And so with this backdrop, our report card says inflation is already sticky before the oil price jump. Mm-hmm. And we now have that problematic scenario. We also have the 2-year yield on the rise, which is being picked up as a hawkish signal for the dollar. So overall, dollar is getting a pretty solid reading in terms of Edgefinder's economic metrics, a +5 macro fundamental score. This has been kind of you can see the score history. Dollar index got bullish as early as, let's see, February 5th. So it's been most of February teetering in the bullish camp here for the dollar index. And I am personally still long the dollar through my short position on the British pound versus the US dollar. I took this position a couple of days ago. Also kind of fits my inline, more risk off feel on markets right now, Chris. I'm short the Dow, short the pound against the dollar. And we'll look to manage these trades accordingly. And the only caveat is I am with you long-term bullish in terms of markets. I sold that 655 put on the S&P 500. So if we do rush down there, I'd take some assignment and start, working with that position.
Yeah, I'm pretty confident you can repair that, no problem. I just took a quick peek. Closed out the Aussie CAD for a nice win. It was like 225 pips. I gave up a little bit. I think I closed it on around the 9,500 handle. We got down to about 94.65. I'd be back to break even if I didn't do anything when we had that Sunday Monday open. So very happy to close that thing down for a nice win. And we'll see what sets up next. Dollar strength, yes, I agree. We're sitting at some key levels on the dollar. A lot of chop here the last 4 or 5 days. If we get a breach of 99.50, we get to 100. I've got this green line up here that is a measurement of maybe just this sideways range. And again, everyone thinks like dollar's doomed, it's going down, blah, blah, blah. I don't know, man. I think it's too crowded that if we just have a box here and that box breaks to the upside, I mean, we've been long since the lows. We had that head fake during FOMC back in September. We're still playing around with those lows. If we get to 100 plus and we measure this move up, that puts us around 104.50 to 105. There's also a big pocket back here as well. The dollar might be a surprising trade. Like it might be a de-dollarization of the world versus a did I say re-dollarization versus D? Yeah. anyway, I think that's the crowded trade is everyone thinks short dollar. But I think that's going to be maybe the surprise move for, and it may not be like an oil, gold, silver. It may not be that exciting, but
Sure.
it might drive, Forex traders crazy when it's like, wait, I thought this narrative on the dollar fundamentally was going to be bearish dollar, and it's not.
Well,
So
and the thing
just
is,
be
Chris,
careful.
nobody knows with certainty what's going to happen
I know
with
nobody knows.
Iran, right? Like we're making an educated guess here that, to your point, the popular trade, I've got it pulled up on my screen here. The
Mhm.
popular trade for quite a while here has been short dollar. We are looking at the hedge fund positioning through the commitment of traders data. The yellow line represents long percentage over time. And so we can see that for months on end, there was an accumulation of short positioning on the dollar index. And we are now starting to see that reverse course in a thematic way to the upside. So we're starting to see a little bit more bullishness on this side of things. And one thing I also want to just check really quick is 10-year treasuries as well have been sold pretty aggressively here recently. What that signals to me is that big money is still kind of thinking you could get an elevated 10-year yield, right? So if they're selling bonds, I think yields could go up. And I think that is sort of the trend that we're seeing here. We're seeing, of course, not helped by the geopolitical conflict, but just generally speaking, we do see some upside pressure on yields that I think for now remain. And of course, if we're wrong, that's where you manage the trades, right? For me, that means stopping out of a position. That might also mean hedging, et cetera, whatever you choose to do. The point is nobody knows with certainty what the markets are going to do. It's all about educated guesswork and risk management. Chris, we're out of time. I'm going to, thank you for coming on as always and sharing your thoughts here on what was kind of a boring CPI day, but at least it's been a very exciting couple weeks.
I think it was a mandatory CPI day, meaning they just had to get a number out there. So what they do, they put it exactly as this forecast. So nobody's shocked. There you go.
There you go.
All right. See you tomorrow.
In there. See you, Chris. Thanks for coming on, man. All right, guys, up next, we have, of course, Tiger Barry taking over the stream. By the way, if you don't know, you can always check the live stream schedule. Just head over to our website, a1trading.com, check the live stream schedule, and you can see who is lined up here. Our producer does a great job putting that together so that you know exactly who is coming on and when, as well as some general topics that they're going to go over. So Tiger's going to be taking a look at some charts here for us. Hey, just a quick plug before we go. Make sure to join our Telegram channel or our Discord if you guys are looking to stay up to date with what is going on in markets. I'll show this to you really quick here. If you pull this open, if you have Telegram, join us in there because we are posting updates throughout the week. Our team does a pretty remarkable job at keeping people up to date, educating people about macro fundamentals. If that's something that would be beneficial to you and you're still looking to learn macro, best way to do it. Spend 5 minutes a day in the Telegram, read our daily digests on what's going on, especially if you're the type of person that likes to read in your visual, etc. That might be worth checking out. Guys, coming up next, we have Tiger Barry taking over the stream for more trade setups today. Stay tuned. Coming in after this. This next segment of the live stream is proudly sponsored by the one and only Ola Prime. Ola Prime is easily one of the most impressive prop firms that I've come across with an incredibly professional team. They offer fast payouts within 1 hour, up to 95% profit splits. They have the largest number of trading platforms. I mean, just take a look at this list. They have MetaTrader 4, MetaTrader 5, TradeLocker, DXTrade, MatchTrader, and CTrader all available to their traders. And that's just for the Forex side. On the futures side, they have DX Futures currently with Tradeovate and NinjaTrader coming soon. Ola Prime has one of the widest selections for challenges and funded accounts that I've come across, with a wide range of account balances you can choose from, like 5 all the way to 200K. And just take a look at the variety of different challenges you can choose from to fit your trading style. They have a 1-step or 2-step pro accounts. They have the 1-step prime, 2-step prime, direct accounts, Ola Prime, 1 challenge. I mean, you have a wide selection here. And the reason this is so important is that you as a trader have a unique style. Everyone does. And finding the right challenge to meet your criteria is very important. If you go through their website, which I encourage you to do so using the link dropped in the live stream chat right now, you can explore in full transparency all of the different account types, all of the rules, etc. They also offer news trading and weekend holding, and they have direct and challenge accounts available. For a limited time, stream viewers get extra discounts using the promo code that you see on your screen right now, and also through the link and promo code being shared in the live stream chat. Take your trading to the next level with Ola Prime. Now back to the live stream.
What's going on, everybody? Happy hump day. Happy Wednesday. I hope you're all doing well out there. We had some more nice hardcore storms over here last night. Friday night, we actually had a tornado touchdown just like 3/4 of a mile north of me. And it went to the east about 4 miles into Missouri. I'm on the Kansas side. So, yeah, it's I live right in the middle of Tornado Alley. So every single day, every single night, we got to keep our heads on a swivel over here looking for those tornadoes. And it's funny because as long as I've lived here, I grew up in Tennessee, but as long as I've lived in Kansas, I still have yet to actually physically see a tornado. And I used to do a lot of driving, a lot of medical transport, things like that. I'm just shocked that I haven't been able to record a tornado. That's still my life's mission. I obviously out on an open prairie somewhere. I don't want it in town like it was the other night because that was a little too close to home. But anyway, good times here in Kansas. As far as the Coke and Pepsi argument, I would have to say Pepsi. But it's funny, guys. I actually don't drink soda. I used to drink it hardcore, 3-4 a day back in the day. But me and a group of friends of mine had a bet that said, that we basically wanted to see who could go the longest without drinking sodas. And so I've went now almost 20 years. I've probably had the equivalence of a 6-pack in 20 years. So I think I won that bet. I went at least 15 years without one, period. But go to my mama's house every now and then for a holiday. She keeps her fridge stocked with Pepsi. So once in a while, I'll drink one and I'll suffer from it because sugar does not do my body good. It knocks me out. But anyway, on to the show, guys. As far as the currencies go from today, we obviously had the, like Nick said, the boring CPI report came out. But I got to say, so far, it's helping out my pound dollar short. I know that's one that we've quite a handful of us have been talking about recently. There's an argument to be made for pound dollar short or euro dollar short, but for me, it's the pound all day because it's the weakest fundamental currency, as we see right here. It's missing out on 4 out of 5 reports on average as far as the forecast goes. So as far as the trade goes, just going and taking a look over here. And as always, guys, let me know if you'd like me to bump any asset to the top of the list. I've got several alerts set, but it's mainly about the Aussie strength, and I'm so that's basically what I'm looking for is some type of way to buy Aussie, and I'm already in a trade selling the pound, okay, which is the weakest currency. So I'm after a currency pair that's based with the Aussies. So, but anyway, yeah, just let me know. But anyway, flipping on over to the pound dollar. If you guys remember, I had this zone on top of a zone look as far as supply zones I was looking at. Took the trade off the bottom zone. It ended up catching a little bit of resistance from the top zone, which is the higher time frame zone. Okay, remember, the higher the time frame, the stronger zones typically are. It did get that initial reaction from the 1 hour zone, but then turn around and right through it, and it ended up catching from the 4 hour, 1 hour confluence up top. So we finally did get a little bit of a rollover. Yesterday, the second half of the New York session finally got that nice drop, and it's just kind of chilling, going sideways, pretty volatile at the moment. But the cool thing is, and what I like to see is the fact that we started to break some structures and close. So when we did break down yesterday, we actually got a close below this recent swing low. So from there, if I were not in this trade, which I already am, but if I were not in this trade, then I was just wanting to watch for a return to a more recent supply zone. In this case, we got a return to this indecision candle here with a strong gap underneath it. So it turned into what would have been a second chance opportunity to short. Okay, we kind of wicked in there quite nicely, and we got that a rejection from there. And just to show you how dynamic these zones can be at times, guys, we caught a bounce from there. In the wake of that second chance opportunity, we got a push down, and it created a new supply zone right here. I just didn't draw it in. I sometimes I'll just let my order block tool do the work if I don't want to get too many lines or boxes on the chart. But look at that. I mean, we had a return to this newly formed supply zone, and now we're getting a rejection from that. And so far from the CPI report, we're obviously getting a little bit of a downward push, a little bit of dollar strength from that, even though it was a meet expectations result. So looking good so far for the pound dollar. Pretty happy about that. And then, yeah, like I said, as far as ideas for the Aussie dollar, I mean, there's Aussie Swiss, there's quite a bit of, I think all these Aussie pairs are on here. There you go. Aussie, so start at the top of the list. Aussie Kiwi, Aussie Yen, Aussie Swiss, Aussie CAD, everything. Okay. Pound Aussie on the short side. So that's what I'm keeping my eyes out for the day, but I figured we'd take a quick peek through those. Just looking over here at my notes real quick. Okay, good deal. Okay, I'm just making sure I didn't miss anything over here. So yeah, I figure we'd take a look at a few of these just from a supply and demand zone, a little bit of a smaller time frame look. But again, if you guys have anything you'd like me to bump to the top of the list, just let me know, okay? Dollar yen 160, Devil Rest says. Yeah, we get up there. Where are we at on dollar yen, by the way? 158.5, pretty much. Yeah, see, you guys, if you remember on the dollar yen, we're kind of bouncing into this 4 hour daily confluence over here. I just moved the boxes to get out of the way, but when it comes to this trade setup, and I don't know, I might have mentioned this yesterday, but when we bounce into a higher time frame confluence like this, you guys see I did clearly draw up a zone here, but this is only a 1 hour zone, if I do remember right. I mean, yeah, see, that's a 1 hour zone, right? So when I drew this alert up here, we had not yet bounced into this higher time frame confluence. So now that we have, that changes my game plan. Okay, I'm now after the confluence, the higher time frame confluence, because if I'm a daily and a 4 hour confluence, I'm pretty sure I'd be strong enough to push through a simple 1 hour demand, if that makes sense. So basically what I'm saying is I now need to move this. Okay, I need to move this one down, move this down here to some of these confluences, because I've got if we go to a 4 hour, okay, I've just got a stronger confluence down here. It's a better discount, but I feel like that confluence would probably be strong enough to blow through these minor demand zone boxes. Okay, so that's what I'm looking for personally for dollar yen. Just get a little bit more of a discount going all the way down here, and just again, we got a zone on top of a zone, much like our pound dollar short. So be looking to catch a bid somewhere down there for a possible long. Because yeah, we haven't quite hit we haven't quite hit that 160 level yet, like you mentioned there. We got close to it, 159.5 back here on back here at the middle of January, but since we haven't. We've just been kind of hiding out just below the surface of that 160 level, right? That potential intervention level. Aussie yen, says Zenny. Yeah, let's take a look at that. Aussie yen, yeah. And like I said, all of these Aussie pairs are on here giving us a very strong signal. Seasonality is pretty good for these pairs. I like that. Crowd sentiment, guys. You got the average retail trader, okay? You got the average retail trader net short these assets. That's why we're getting a +1 on the crowd sentiment, okay? So combination of that, and depending on the asset, you got your put to call ratio, you got your AII investor survey. Nick goes over every Thursday. I think it's Thursdays when that's released. So yeah, very good contrarian signals. And then not to mention the Aussie was bought up hardcore for the banks this past week. Remember, that was the only one. That was the only major currency that was bought up. Everything else was sold off. So that's a big reason why I'm interested in the Aussie pairs. Okay. So anyway, yeah, let's go have a look at that for you. Aussie yen, and we might as well look at all these Aussie pairs since I've got them all clustered up down here. Yeah, and that's the thing with the Aussie pairs. Let me turn my space heater off. Starting to roast down here. These things are just runaway freight trains right now. Having a look at all these Aussie pairs. So, to me, it'd be a little silly to be trying to buy anything up here at a premium price. Okay, especially when we look to the left. I mean, look at it. We need a break. We need a little bit of a breather. So for me on Aussie yen, I've got a breather or a demand all the way down here. There's a few different options down here. But I at least need a pullback on this thing, at least to this area, because I do have, that is the closest demand zone. Yeah, I could probably on a smaller time frame find something up here. But I don't really have I mean, it's just kind of hiding out there in cyberspace. I want to return back to some of these former resistance points down here. So definitely asking for a lot. I mean, on that pair there particular, how many pips is that? It's a long ways. It's 100. That's almost 200 pips, right? And it's kind of how you look at this thing. So sometimes for me, I'll get a little more lenient when I have a very bullish signal like this. Okay, I may be a little interested in buying a little higher on the curve, guys. Because when you got scores that are this strong, or it's got as many odds enhancers in its favor as we do on some of these Aussie pairs. Okay, I've been known to drop down to some smaller time frames and look a little closer to home. You see, I have an alert right here. Let's go dig into that. 30-minute, I believe it was. Yeah. Okay. I mean, this is a little more. This is a little more aggressive. I'll have to say that. It's not giving me as big a discount as I want, but hey, look, if I get if I go to a 1 minute, a 3 minute, 5 minute chart, if I get a really strong bullish candle, okay, something with a really strong wick, but then I might be interested in taking a little stab, just a very small percentage stab, guys, not anything, not a regular size amount of risk. Okay. Just tiptoe in and highly enforcing the VSA candle strength. Okay. I gotta see some yellow strength, some red strength, some ultra high volumes start picking up. But it doesn't happen that often, because if I'm a bank, I can't just be getting into a big position right here. That's way too little time. So that's why I like to play around down here in the bigger discounts, because that's where the institutions are playing. Okay. They're not necessarily playing on a 5-minute chart. So it's really kind of a little bit more of a battle against the retail traders. Okay. It's just a little sketchier. So I'm going to keep an eye on that, but likely just skip that and just wait for the bigger discounts. So yeah, there's you a couple options, man. I mean, obviously, like we say all the time, not financial advice. I'm just telling you based off of 12 years of studying supply and demand zones, kind of what I see. And this is why it's so nice to have the Edge Finder to let us know, hey, are we just limping in with a +5? Or do we have something very strong to where we can be a little more aggressive with potentially buying, in my case, a little higher on the curve, right? So I don't do this too much, but another cool thing to do is, for me, I like to look at my EMAs and see where they've been bouncing. Okay, there's your 50. It's getting a bounce. There's your 50 coming down close, getting a bounce. So that's basically where we're at now. So this is kind of where we always say, history doesn't always repeat, but it does rhyme. If we get bounces consistently off of some of these moving averages, well, hey, maybe we could take a little bit of an aggressive approach. So that's part of the reason that I'm keeping an eye on this, just looking for a bounce from the 50. So I wouldn't recommend that, especially if you're a beginner. I would be more interested in a discount to some of these, some of these stronger zones, if you will. So hopefully that helps for you on Aussie yen. But yeah, higher probability. I'm asking it to come back quite a bit, about 180 pips on that one. What else we got over here? What else have we got? That's right, Tylee, pound bearish continuation. And it's been a little bit more risk on of late. It really has. Monday was obviously, just kind of a continuation of last week, where we were very risk off, where the Dixie was flying up, where oil was flying up. But they've kind of retreated. Obviously, oil's retreated. It's retreated, but like Nick said yesterday on his video, guys, it's retreated, but it's still at a very high elevated level, after it's kind of settled in. Let's go to oil real quick. Okay, we've basically retraced most of all that. Well, we've retraced all the gap actually, but still pretty elevated. I mean, $80. When just as recently as the beginning of the month, we were well under 70, 60, 70 area. Okay, but now we've settled at the 86 half level basically. Okay, at the moment, not settled, but this is just kind of where we are over the last couple of days anyway, experiencing a little bit of fair value. Okay. This is agreement. This is buyers and sellers playing around in the same spot. So basically looking for a breakout of this area for me. you know, if I were wanting to be a buyer or a seller of oil, I'd be wanting to see what happens when we kind of leave this area here. Okay, that consolidation zone. It's going to go up. It's going to go down. That's the question. That's the question. But as far as some more of these Aussie pairs down here, let's take a look at these. Okay, again, we got Aussie Kiwi, Aussie Yen. We've went over Aussie Yen. We've already went over that. So Aussie Kiwi, Aussie Swiss, Aussie CAD. Let's go look at those. Okay, Aussie New Zealand, the strongest one out there at the moment. I mean, look at that. We're buying out in outer space, guys. Okay, I don't have the and obviously when we got the fundamentals going that much in favor, I don't want to be trying to short this. Okay, I'm not one of those crazy guys. But looking for a retracement, obviously the higher probability zone, very similar to the Aussie Yen I just mentioned. You know, the highest probability is going to be way down here. And of course, we'd be asking a lot of it to drop. What is that? About the same, 180 pips on something that's given us a plus 11 score, right? So I don't know that I recommend it, but yeah, you know, sometimes I just like to follow the, you know, the 50 EMA, the 200 EMA on some smaller time frames, see if we can't take a stab at this. I mean, you know, I did draw up this zone last night before I went to bed, just kind of hanging out on its own. I like zones like this, guys, because it didn't create itself as a result of bouncing off a previous zone like we did down here. See, I drew these zones up that worked pretty well. Very aggressive. Let's go back in time for a second. Okay, very aggressive push up. And I do remember, yeah, so starting down here kind of at the origin of this strong move up, we kind of had that push up, the bounce off the 50, the bounce off the 200 area, and then it just rode it. It just rode it nice. And then we get up here a little higher up, we get a couple demand zones. I wasn't sure which one might catch a bid. It just turned out to be the smaller one. And guys, that's a 5-minute time frame where I drew this up. Okay, we're talking about a 5-minute demand. So we're getting a little down in the weeds, down in a very, very noisy area. But if you stare at something long enough, you figure it out. So, not saying I've by any means figured this stuff out. I still take losses like everybody else, but you know, I mean, we're great. We're great. Okay. 15, dropping over that 50 EMA. Well, on that 5 minutes. So, like I said, it's very aggressive, but it's just hard to catch. It's hard to get a discount in some of these markets. So, you know, it is what it is. But by the time, if and when we can get price to come down to this zone, I'd be possibly interested in it from a very aggressive type of approach. Again, it built itself, it created itself out in cyberspace with nothing to the left, you know, beating it or bouncing price up. Consolidation, 5-minute, big push. But ultimately, the smarter play to move, the better discount move would be about 180 pip retracement, guys. So that's Aussie Kiwi. Aussie Yen we went over, Aussie Swiss. Now on Aussie Swiss, we're still trying to figure out if we want to chew through the rest of this daily supply zone up here. And it looks like we're through about 90% of it. So that in itself is a pretty bullish signal. Okay. Just from a technical, if we're just isolating the technicals for a second. Okay. And we've already created a new impulse leg because we broke this structure over here. Okay. When we break structure like that, I like to just isolate my eyeballs to areas like this right here. Okay. Just talking about just that leg of price movement right there. I want to put my blinders on. Okay, if price is strong enough to break an opposing supply zone or a demand zone or a support resistance line, then this is where my eyeballs stay right here. It stays on this leg of price action. Because from this leg of price action, that's where I draw up my curve analysis. Okay, curve analysis. Where am I at on the curve? Right now, I'm at the top half or top third, right? I'm in the premium zone in a bullish asset. So there's nothing I can do unless we drop down to the bottom third. Okay, we got our middle zones, and you see where I drew up those demand zones on smaller time frames. They're in the middle, so it's a little risky to be buying in this area. This is where traders get chopped up quite often. So I just need a bigger discount on this thing. And on Aussie Swiss, it doesn't move as fast as some of these other pairs. A lot of these Swiss pairs are, a little on the slower side. How many pips is that, by the way? Yeah, 60 pips. So that's a slower moving asset. It's not quite molasses like a euro pound, but it's still pretty slow. I like 80 pips or more, really 100 pips or more as far as average true range, but that's just because I've been staring at these things for a long time. If you're a newer trader, I know we get asked that question all the time. Hey, I'm a beginner. What pair should I start with? My best advice is starting with something that moves a little slower. Okay. You don't want to be driving a Porsche or a Lamborghini when you're getting your driver's license, right? So I'd be staying away from a pound yen or a dollar yen, some of those yen-based pairs that just fly like crazy. At least for the start, just to get used to it, right? Start with a euro pound or even some of these Aussie Swiss type pairs. Okay, until you get your driver's license. And then, I did want to also make sure and mention about Nick's discount code, guys. If you're looking for a new prop firm, check out allaprime.com. He does have a code, A1T35, where you can plug that in if you're looking to get a challenge account. It'll give you 35% off. If you're looking for some, looking for a new account or a different type of account. I love the place. Love them because of the platform. I know I go on and on about that. Trade Locker is my new favorite. So if you guys have any thoughts or questions, you're more than welcome to reach out to me. I know I did have one or two reach out to me yesterday about the SOPs to end my conversation yesterday. So I got them some information. But if you guys have any questions about prop firms as well, or the one that I'm used to work with, definitely reach out at Trade Like a Tiger on all the socials. And I'd be happy to help out. So take one more look at the chat real quick here before I get up out of here. I know Mr. James is coming on next. You guys will have to ask him as well, Pepsi or Coke. I'd be interested to see what everybody says. Trade Locker is slow for me, Eric Cross says. Oh, dang. Yeah, I haven't experienced that. I mean, they do a lot of updates and upgrades, especially over the weekends. It gets kind of annoying when you're trying to look at, do some analysis on it. But, hey, that's what we got TradingView for, right? So sorry about that, though, as far as the slow Trade Locker. Zindy thinks Tiger got the EF and passed 2 prop accounts already. All right. Hey, look, it's tough to pass a challenge, but sometimes it's even tougher to start making money after, guys. So now you're onto a new set of challenges, but just don't change a thing. Whatever got you to pass that account, this is for anybody. If you guys pass an account on a challenge account, regardless of what company they are, there's so many times, and I saw this a lot when I was with Ola Prime. People would pass accounts, but then they turn around and blow it within that first couple trades. Don't change a thing. The same rules that helped you guys pass the account are the same rules you should be sticking to. But so often people get away from that, because what happens when you're very conservative and you pass the challenge account? What happens? People start looking at it like a slot machine. Well, it's not my $100,000, okay, of demo money, right? It's not my $100,000. It's not my $50,000. So now I can just throw as much money in as I want and pull the handle, let it do its thing. Don't do that. Trading is a long game. It's not a short game. So many people look at these challenge accounts, especially challenge accounts, because it's not their own money, as a slot machine. It's not a slot machine, okay? So just stick with your rules. And again, that's why I brought up SOPs yesterday. That's why I made that video. So definitely, guys, go check out at Trade Like a Tiger on YouTube if you want to check out my video I released on Sunday, talk about SOPs. It's a boring, rigorous setup, but you have to have a boring, rigorous setup in order to make it, okay? We're not in trading to be entertained. It's supposed to be boring. It's boring for a reason, guys, but focus on our whys. Okay? Why the hell are you in trading? And don't make it, hey, I'm wanting to buy a Lamborghini. Hey, I want to buy a whole bunch of Rolexes, right? Have something deeper than that. Figure out your why. That's you guys' assignment for the day, okay? Let me know what your whys are. And with that, ladies and gents, it's already the end of my stream. Look out for Mr. James coming up right after me. Take care. And yeah, I'll let you know tomorrow how my pound dollar is going. So have a good
Hey stream viewers, if you're outside of the United States, I have a cool offer I want to tell you guys about thanks to our partnered broker, 8cap. 8cap is currently offering the ability for new depositors to get access to our premium tool, the Edge Finder, completely for free. Now, how this works is basically you create an account and deposit a certain amount of money into that account, and they will essentially buy the Edge Finder on your behalf. So it's a win-win-win. They get a new client for a reputable brokerage, you get access to the Edge Finder and a great brokerage to trade with, and you'll be supporting the show by signing up with 8cap. Now, here are the steps if you want to find out more about this specific offer, but make sure to follow them specifically as we list them out on the screen here. Step 1, navigate to a1trading.com/8cap. That's a1trading.com/8cap. Step 2 is to follow the instructions and to make sure you use the specific link on that screen to sign up for your new 8cap account. Step 3, complete the required deposit amounts and contact their team as instructed on the page. So if you're interested in finding out more about this offer, head over to a1trading.com/8cap, and we'll also be dropping the link to this down below in the live stream chat as we speak. Like I said, make sure to follow those instructions specifically if you'd like to get access to a free copy of the Edge Finder if you meet the deposit requirements as listed on the website. Full information, like I said, can be found a1trading.com/8cap. Now back to the stream.
Hello, ladies and gentlemen. Happy Wednesday. Hope everyone's well. Okay, so not much going on my side at the moment, really. I'm not very happy with the state of the markets. So what I mean by that, there's just no opportunities at all. There's markets I'd love to be in, but just can't find entries. So for example, the pound Australian, I still really love this idea, but it's just far too stretched. It's at the point where it, slows down a little bit, and you think, oh, maybe here we could have a bit of a pullback for a potential entry. Oh wait, no, we just continue lower. Maybe here we could have a pullback, potential entry. No, we just continue lower. It's becoming a very frustrating market, really, to be sat on the side of, but it is what it is. But the problem is it stretches across markets. So Euro Australian, similar problem. Australian New Zealand, similar problem. Australian dollar Swiss. So yeah, there's just not really much going on. So I'm in two positions, which I'll go over shortly. I'd quite like the idea of being a buyer of the indices markets. So not necessarily US markets at the moment, but I'd quite like to be involved with the Nikkei and the Aussie 200, which is obviously the Australian dollar index. But at the moment, I don't really have a technical entry for these markets just yet. But when it comes to the Aussie, the reason is we've got this really nice bounce off the 200 daily moving average. So I'm just looking to see if we can pop back above and have basically a repeat of what we saw over here and potentially have a bit of a reversal. I'm not sure that's going to happen. We do have the RBA that's sitting quite hawkish. We obviously got a little bit of risk sentiment in the markets as well with the US and Iran situation. So not my number one idea, but it is on the watch list for now. Aussie yen, again, love the idea, can't get into it. Silver is kind of the only trade at the moment that I am maybe going to take. However, the problem with this one is the Edge Finder doesn't have a reading for silver. Technically, it looks really nice. So we're in the H4 previous resistance here. So we've got the break. Looks like we're having our retest here, also in line with the 200 moving average. This is also the 50% pullback. So technically, looks fantastic, but fundamentally it's not really there. So that's the problem. You see, we've got markets with very strong fundamentals, no technicals, but then we've got really strong technicals with silver with no fundamentals. So annoying, very, very annoying. So I'm in a very small, I want to say small, I mean small risk, very, very low risk position on the Russell, just looking to see if we can continue lower here. So technically, obviously in a downtrend on this H4, that was a horrible arrow. We've got the 200 and the 50 moving averages, obviously indicating a downtrend. We did come into the fib zone. We did slightly break above, but then broke back into the value zone, or this fib level. So I decided to execute short here. So far, pretty much break even, so nothing of real interest there. And then a euro dollar short, which I'll go over in a bit more detail in a second. Basil, hello. Sluggy, hello. Good to see you all. Retook it and got a better entry on what the Dow. I saw you were short Dow in my Discord, which is quite a nice play. I've not checked the Dow actually. Yeah, similar price movement to the Russell. So yeah, fair enough. The reason I went with the Russell and not the Dow is just because the Dow position sizing with IC markets is massive. So even if I took the smallest position size, it still would have been a few $100s, which I'm not wanting to do. So with the Russell, it allows me, I can put 60, almost $70. I don't mind losing $70 to have a go. But the Dow, again, position size, minimum position size was still far too big for what I'm wanting to put on the line here. So just to quickly go back to the Eurodollar idea, as you can see, we've got MUFG short stop, MUFG short opened, and MUFG short target. So here, I've realized also, I've not shown you guys any reports in months. It's probably 4 or 5 months now since I've actually brought a report up on stream. So I thought I'd go over this one with you. Not in much detail. I'm just going to show you the call out that MUFG made. So they are short Eurodollar, opened at 1.157. They're targeting 1.13. Stop loss, I assume, was a typo. I'm going to think that's 1.17.5. So they are recommending, and when I say recommending, that's not me, this is their words, recommending a new short on Eurodollar trade idea to reflect our view that the Middle East conflict is likely to worsen before it improves. Developments over the weekend, most notably Iran's decision to appoint, I'm not even going to attempt to pronounce that, as the new supreme leader, indicate that Tehran is unlikely to de-escalate in the near term. So basically, they're just talking about the Iran situation. So as we already mentioned, they're expecting that to basically just get worse. So overall, the MUFG short Eurodollar. I quite like the idea of being short Eurodollar as well. I mean, it's not really it's not at all getting a bearish reading on the edge finder, but pound dollar is. I'm not a huge fan of pound dollar. I think Eurodollar has a little bit more potential in my view. So I'm not really looking for any specific target. I'm just going to layer in. So as you can see, it's a very small position size of 0.03. If we end up coming back up slightly, I'll add in again and just start building up a bit of a DCA or layering approach on Eurodollar. The cutoff point for that would be these previous highs over here. So around, let's just say 1.185 would be the sort of mental stop loss on the DCA approach here. So last thing I wanted to show you was this. So this isn't really a trade or anything. I wanted to get your opinions. What do you think an institution uses for their technical analysis? I'll give you guys a second to drop your thoughts in the chat because I'm curious, because we see a lot of talk on social media about, order blocks and all these things that institutions apparently use and trading like smart money and all of these ideas. So I want to show you what is actually used. And this is only Lloyd's. So it's not speaking for every institution, of course, but the ideas shown in here are pretty broad in terms of it is generally what is used on an institutional basis. What's your thoughts on GU? The short is so popular. I don't like GU short. And the reason let's just quickly have a look at GU on Edgefinder, and then we'll go back to the technical PDF. So the reason I'm not really liking the short reading is because it's not good enough. So anyone that watches my segments frequently will know I like to have mainly these bottom boxes to be the bearish driver. At the moment, actually, this inflation data is kind of new. It wasn't inflation. Inflation was neutral when I was actually looking at this reading. So technicals, fine. Economic growth, fine. But then COT is neutral. Retail sentiment is neutral, job market's neutral. There's just not enough there really for me to be overly interested. Do you know what I mean? So if there's an entry that comes, I'll probably take it low risk, but again, it's not great for me, to be honest. Anyway, let's move on. So supply and demand, SNR and FIB. Interesting. Okay, so not silly replies, which is nice to see. So pretty much, yes. So they've got trend lines, they've got moving averages, and they've got pivot points. And yeah, basically supports and resistances. So they're drawing up highs using the wick highs and also the body highs that you can see over here. They've got, I'm not sure exactly what moving averages these are. I would assume they're a 250 or a 50 and a 100. I assume, it doesn't say, so I'm not 100% sure, but either way, moving averages. There's a trend line over here. So, what I'm trying to say is what you see on social media a lot of the time about, you know, trading like smart money, or the banks enter on order blocks or liquidity sweeps or whatever, it's nonsense. Where is any of that? I mean, these types of reports put out all the time. There's another one, I think it's SocGen, that put out technical reports. It's very basic technical analysis. It's all support, resistance, trend lines, moving averages. There's sometimes oscillators. You can see there's a fib here as well. So whoever said fib, well done. But yeah, I wanted to show this again, just to show you what actually is going on when you're trading the markets, or what other traders are looking at. Does that make sense? So yeah, I mean, there's not really anything overly interesting, to be honest. Again, just some pivot points over here. So that's what R4, R3, R2, R1, S1, S2, 3, and 4. They are just pivot levels. And then yeah, basic SNR. So yeah, simple stuff. Bitcoin's moving. Let me see what Bitcoin's doing. Yeah, I'm still a bit skeptical on Bitcoin. There's like, I'm very 50-50. 50% of me really likes this level that we're currently at. So we've obviously got the 200 weekly moving average. We've got previous structure here. It's very much break retest type pattern here. And the RSI on the weekly is oversold. However, we've discussed this many times, but if we look at the previous crashes in Bitcoin, so back here, sort of 2018 period, we had almost an 85% crash. Over here, I think it was 2021, 2022 period, we had about 75%. So if we're looking at those and taking, let's just say, an average of 80%, that would bring Bitcoin to, let's say, 25,000 for a round number. We've not had a crash that size yet. We're currently at 46%. So I'm not saying we're going to crash down to 20, 30, 40,000. I don't want to make that call, but it does make me a little bit worried to be a buyer here. So we'll see. But yeah, I think if you are a bull on Bitcoin and you've got your own reasons to be buying, I think this level makes a lot of sense. And if I was involved in crypto, if I actually, you know, fully understood Bitcoin as an asset, I probably would attempt to buy here. But because I don't trade Bitcoin, it's not something I'm really bothered about. However, having said that, if we do end up breaking lower and we see, I don't know, let's say a pretty reasonable pullback, let's say to around here, we come meet the 200 moving average, we come down, break and retest this level, maybe I would go for a short position, mainly on a technical basis. But yeah, it's definitely not on my watch list to actually trade yet. That's so underrated topic. I remember Market Wizards used to have a very simple technical system. They focused on fundamentals. That's the thing. The institution, in fact, it's actually not all of them. I think there's 2 or 3 of the institutions that will put out technical reports. Again, I think one of them is SocGen. I'm not 100% sure. Lloyd's obviously do it, which I just showed you. And I think there's one other one that do it as well. In each of those, they will use an RSI, a MACD, or some sort of oscillator, normally a stochastic, actually, a moving average, support and resistance, trend lines, fibs. It's very, very basic. It's not, you know, this micro analysis on individual candlesticks, because it doesn't work. Oh, well, it doesn't work for the majority of people, I should say. But yeah, that's really just what I wanted to show you. Do you trade JSE? No, I don't. I'm not 100% sure what the JSE even is, to be honest. BMNR finally showing life again. No idea what that is. I'm assuming that's a stock, but I don't trade stocks. I am purely a currency degenerate trader. Gold, yeah. So gold's got nothing, and this is why I'm pretty much paralyzed in the market right now, because there is really nothing to do. So the positions I do have are very, very boring because they're very low risk. There's nothing overly interesting about them. Gold, yeah, I mean, maybe there's a long position idea. We are still in a pretty healthy uptrend. We've printed a higher high relative to the previous high. We could maybe come back into sort of this fib zone here and see a bounce. That might be again, that might be an opportunity to be a buyer. But when we refer back to the edge finder, there is nothing there. So there's no, excuse me, there is no reading for gold either way when it loads. So yeah, I mean, gold's got a neutral reading of 1. So what can we do here? Today's CPI, I'm fairly sure it came out flat if my memory serves me right. Let me just double check. I don't think there was any interesting data. Yeah, so here, completely as forecast, neutral. Wait, oh, it's the 11th. Hold on. Yeah, no, that's right. Yeah, completely flat. So yeah, I mean, in terms of the dollar, the CPI report really doesn't do anything. I think the markets are very likely to discount today's report anyway, even if it came in cooler because of the increase in oil. I think a lot of traders really are going to be focused on the next CPI print, which will reflect any impact that oil did have. Excuse me. So I wouldn't, even if we did see CPI come out cool, I don't think the markets would have started pricing in a rate cut or anything like that. Having said that, we did have a very poor NFP report and unemployment report as well previously. So I think if we take oil out of the equation, yeah, we're looking at potential cuts. Stochastic VWAP and MAs are very popular on the institution side. Yes, exactly. VWAPs are used for execution. Moving averages are used for trends. Stochastics are used for, sort of filtering overbought, oversold and situations. CPI report keep higher than will gold still be uptrend. High CPI means less rate cut. Not necessarily. So if we start getting a more hawkish Fed, then very likely gold will remain pressured to the downside. That doesn't by any means mean that gold will suddenly flip bearish and we're going to see it crash down to 4,000 or something. But it does mean I wouldn't expect gold to just continue to rally. It's likely to stay sort of like this price action, where it's just maybe a slight move to the upside, but not a clear, defined super trend, if you will. US 30. Yeah, I mean, I quite like the idea of being a short seller on US 30 at some point, but I find it very difficult to sell the indices market. So I have to be very, very clear, and there has to be an absolute reason. So when it comes to currencies, for example, central bank divergence, fine, we can trade that. It's a bit easier to trade in my perspective because I'm a currency trader. When it comes to these markets, if we just zoom out and look, the natural drift is to the upside. So being a short seller naturally will be a lot more difficult. So it requires me to have a very, very solid reason, like a black swan event, like COVID, maybe like US and Iran. Now, if we have a look at the Edge Finder, we do have a bearish reading, or at least we did. Let me double check. Yeah, so the Dow is actually not overly interesting. It's getting a neutral reading of 4 at the moment. I think it flipped, or it was -5, I'm fairly sure. But either way, the Dow is getting a bearish reading. The H4 timeframe is bearish here as well. So we can see moving averages flipped bearish. We did have a bounce of our 200 daily moving average. Complete failure to come any higher, and we're now seeing selling pressure stepping back in. So to be completely honest, I really like the idea of being a short seller. Now, I think, oops, didn't mean to do that. I think the situation is I unfortunately missed the ideal entry. So really what I wanted to do was sell probably here. So it's basically what I did with the Russell, but on the Dow. So I would have liked to have been in, but as I said earlier, the minimum position size on US 30 on this broker is extremely large. It would have been a few $100 risk, which I wasn't willing to do. So I did have to go into the Russell by proxy. So it's basically the same idea. I do think the Russell will be a little bit more hard hit if we do get a hawkish Fed, or we see the Fed continue to come out hawkish or even more hawkish, because it's obviously made up by small caps. I feel like I'm doing a lot of talking, more talking than normal. Maybe that's just me. Where can we download the Lloyd's technical chart pack? We get them from a proprietary vendor in my Discord. So I'm not sure, honestly, where you can get them publicly. This isn't a plug, by the way. If you want them, they're in my Discord. But the majority of them aren't just given away to the public. They're made, and to be honest, I shouldn't have them, but they're made for institutional clients and their in-house teams. Where do you get the resources? Well, there is a website actually called I think it's FX Watcher, but it's $250 a month, and you do get all the reports, but they're sent to a Google Drive. So if you want to spend that type of money on them, fine, but yeah, it's up to you. The flat CPI was for Feb with recent. Oh, yes, Sluggy, that's exactly right. Banks and markets are smarter. Yeah, Sluggy, you're on it today. How do you objectively take profits? There's two situations. So sometimes I'm kind of in the middle. So normally I'll have a hard take profit level. Let's just use this trade, for example. Actually, sorry, let's not, because it still runs. It's a bit harder to visualize. Let's take pound Aussie. So let's hypothetically say we were short here, or I was short here, and we were running down here. Now, let's say my take profit, where I really wouldn't want to be in the trade anymore, would be, let's go to the daily to zoom out a bit further. Let's just say down here. So what I would do in this situation, there's two things we could do. Either we could just cut the profits, which is sometimes what I'll do if the trade's running on too long and there's other things I want to get involved with and my exposure is getting a bit high, or we can just trail stops. And this is what Nick does, which I prefer, but it does take a bit more time. So for example, if you stops here, you could go to break even on this high, and then on this high, you could just trail it to this high, or basically just trailing behind each previous high or previous low if you're buying. And that way you can always lock in profits whilst letting the trade run and allowing it to breathe. But again, sometimes that does take a little bit too long for me. I like to be a bit more quick and agile. So yeah, sometimes I will just take profits when we reach a major level, whether it be a weekly support or a resistance or whatever it may be. But yeah, that's pretty much it. So I don't have a hard systemized rule on take profits. It really can vary depending on each trade. Sometimes I'll go for a 1-to-1. Sometimes I'll look for a 1-to-5. No specific thing. So yeah, I mean, there's not anything really to look at, perfectly honest. I mean, Aussie, New Zealand, I would love to be in this market. I was a buyer quite a while ago, unfortunately closed it. Big mistake. But on the other side of that, we've discussed this, I think, a lot at this point. We've mentioned this on almost every stream, but the Aussie, New Zealand is really worrying me a little bit here. The technicals are concerning because we've been in a range since 2014. We've not broken out until now. So this is, what, 11 years, give or take, 11 years of just range-bound movement. And we've finally broken out with no pullback. There's been absolutely nothing. Bear in mind, this is a weekly time frame. At some point, I would expect us to start aggressively pulling back, which is what we call a mean reversion, back towards our 200, 100, or a 50 moving average, or even just to retest these sort of previous highs or resistance level. Whether that will happen now, whether it will happen in a month, whatever it may be. But be ready, because as soon as the fundamentals flip on this market, I do see that as the most likely outcome, that we are going to mean revert very hard. What do you think of euro-dollar shorts? Yeah, I mean, I'm in a euro-dollar short, very small size, but I'm looking to scale in as price moves against me, so a DCA approach. MUFG is already short as well, so they opened a short down here. They're looking at 1.13, and they got a stop loss of 1.175. Prepare for next hike. What, by the RBA? Yeah, it does seem like that. I'm fairly sure the edge finder is, yeah, here we go. Let's see what the edge finder's interest rate projections is saying. Interest rates data projections. And let's add Australia. Yeah, so what we can see is Q4 2025 to Q1 2026 rate hold, Q2 rate hike, and then a hold throughout the rest of the year. So on the interest rate projections here, it's looking like we could be expecting one hike, but in comparison to some other central banks, that's quite a lot. So for example, the Bank of England, this red one, we can expect cuts. So again, pound Australian, fantastic short idea. The Bank of Japan, so the yen, even if they do hike rates, it's still significantly lower than the RBA's interest rate. So it still could be a good long position. So Aussie yen, which is down here, will still be an amazing long position. But again, it's just trying to get that entry. It's such a messy, choppy market. Obviously, we are moving to the upside, but it's definitely not a smooth ride. So, yeah. Aussie New Zealand has been unusual trade. Glad to stay out of that market. It has. I mean, the fundamentals have been phenomenal and the trend has been phenomenal, but yeah, it was a little bit of a violent one. So there has been many opportunities to get in. Granted, I missed quite a few of them actually, but you know, on a daily time frame, you would have had maybe this if you were very aggressive, maybe this one, and maybe this one. So 3 opportunities on a daily time frame. If not, then you know, how could you have possibly gotten into this? Very tricky. Okay, so is there anything else? I don't think there really is. So I've got about 4 minutes left, and then we've got the one and only Alan Perez coming to take over. So let's just do a quick final check. So the Russell's here, which is nice. That wasn't there before. So that just backs up my position a little bit more. The 10-year Treasury is getting a bearish reading. China 50. I don't really like China 50 though. It's a bit of a difficult market to trade. I traded it once, I think a couple of months ago. It was horrible. Euro dollar's getting a bearish reading as well, which is nice. Pound dollar's get increased now to -7. So maybe pound dollar's back onto the potential trade list. Let's see. Yeah, to be honest, I do like the idea of being short. So maybe what we could do is actually look to go short pretty quickly. So stop would be stop could be quite tight because the 200 moving average is quite close to price. We would use the previous high here as a stop level. If we end up breaking back above, that would break the previous high, it would break the fib, and it would break the 200. So at that point, I'd be quite happy to be out of the position. That would then obviously allow us to see if we can get pound dollar to continue running lower. So I know earlier in the stream I said it's not a trade I particularly like. I actually changed my mind because now the Edge Finder is backing up the idea slightly more. Did I buy the DAX? I did not. I know I wanted to buy the DAX. Luckily, I didn't. I stayed out of that one. So what I was looking at on the DAX was this on the daily time frame here. So this 200 moving average behavior where it's 200 support, 200 support, 200 support. I was looking to see, can we get the same thing right here? Maybe we still could, but right now, not a huge fan of that. So yeah, kind of just sitting on the sidelines at the moment. There is nothing for me to really get involved with. But yeah, I think the Russell might be the best one. So I think I'm going to scale into this one if I get the opportunity. Now it's flipped on the Edge Finder. I think pound dollar could also be a great position. Euro dollar, as I said, I'm going to build up a position with small position sizes and see if I can get a bit of a runner over the course of maybe a week, 2 weeks, 3 weeks. And then when it comes to the Aussie pairs, so pound Aussie, Euro Aussie, Aussie New Zealand, it's just a case of waiting for if we can get any pullbacks. I was looking at this last week. It was in my watch list, actually. If any of you guys watch my Sunday reels where I talk about my setups really quickly, this was something I pointed out. I think I did anyway. Unfortunately, I didn't take the trade, so a little bit salty about that, but it is what it is. Is there anything else I need to go over before I head off? I don't think so. So yeah, I think I'm going to stay away from silver. Technically, as I said, I really, really like it, but I'm just not convinced on a fundamental level that this is really ready to scream higher. It might be an opportunity to start accumulating some more silver, but again, I'm not overly optimistic about silver at the moment. I think we could potentially see some lower prices that will be obviously more beneficial to start accumulation. So, start of the year, I was long Russell. Now I'm short. Crazy how markets flipped. Yeah, I know. I mean, definitely wasn't on my bingo card for 2026, the situation we had, but that's the financial markets, and that is the world we live in. Got to be prepared. I mean, oil has been violent. So, I mean, yeah, I mean, how really was this tradable? So, yeah, I mean, I was a little bit annoyed about this because I've spoken about this quite a few times, but I was long down here, closed out. I think it was around up here, maybe roughly that type of idea. Bought again here. And this was a Friday, I think, and then closed out Friday evening for around here. Then we got the escalation, and I just missed all of that pump. I was so frustrated, but it is what it is. But yeah, it's a tricky period to be trading. Brent's doing a similar thing. So to be honest, maybe short oil could actually be an idea because we do have the oil reserves. I think it was 30 days worth by NATO. Anyway, ladies and gentlemen, I need to head off. I've just realized my time is up and we have Alan Perez coming to take over the show. Guys, have a fantastic rest of your day. Stay safe. Don't get margin called and don't go anywhere because Alan will be coming to take over.
If you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free-to-join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, bonus clips from the live streams and videos, giveaways to our products, prop firms, and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
Good morning, everyone. Hope everyone's doing nice and good today. We got another trading day ahead of us, operating under this time here. And we did have CPI today. So let's go ahead and look at that, talk that over. I'm sure the guest here did go ahead and already discuss CPI. It came in at 2.4%. Actually, we're seeing some comments here come in as I'm talking. Trump says, again, the war with Iran will end soon. Nothing left to target in Iran. So he's basically, I guess he's claiming that we bombed them and there's really much nothing left to bomb. So we'll go ahead and see what that will look like, what that will mean for markets as the day progresses. IEA did say that they're going to release 400 million barrels of oil. So we'll go ahead and see what happens. But the actual headline today, the news release was CPI. So it came in pretty flat. So same as last time. So not a tick up, not a tick down, which is, I guess, good to see. This didn't really affect or include the recent surge in oil prices. So this is basically everything pre that. We will actually see next CPI release what the implications of this elevated oil price really means for inflation and how much it's going to trickle into. But as of now, we do have the dollar up a little bit firm here today, mostly because of rising yields. So the whole curve here from the short end to the 2-year, all the way from the 10 and the 30 is up on the day here today. I did make a post on the Telegram channel. So for those of you, I know there was a quick ad here right before I came on, but I definitely recommend join the Telegram channel. I post the 2 most important chart markups of the day, basically going over what that could mean for markets. And today I did, say about CPI, it's behind us, and you should watch the yields for clues. And so I'll go ahead and, go over that right now. Yields right now are pricing the prospect of elevated inflation. And you see that around the globe. So you can see that with the Aussie yield here, the 10-year yield, Kiwi yields are elevated as well. Up in the Eurozone, price action is looking pretty close to us. Japan has been elevated for some time. So they've been hanging out at 2.12s for some time here, but nonetheless, they're still elevated. The gilts here for the UK are creeping up there again, and the Swiss as well elevated a little bit there. And you can see that so the whole world is basically bracing for that elevated inflation. For the US particularly, it's very important to watch the US 10-year yield because as of now, the US dollar has been acting as a safe haven. So higher yields across the board doesn't mean technically or that it's going to be good for every single currency if they start to hike rates or if they get themselves in a pinch. It really depends on the overall environment. Right now with the US dollar, it's acting as a safe haven. So higher yields means that it's going to be pretty strong. And so I'm watching the US 10-year yield for direction because, the dollar direction impacts my current trades that I have open. Right now, I'm long Aussie dollar and another basket of currencies with the Aussie CAD, Aussie Swiss, Aussie dollar to be exact. And so if we start to see a firmer US dollar, then it may make sense for me to start looking for an exit. But as of now, I want to see what happens here. As we are seeing these headlines come across the tape that there's going to be some de-escalation or that it may end soon, perhaps you do see a continued decline in oil. Maybe yields drop on the prospect that, okay, maybe this is behind us. This was just a short hit of that and nothing to worry about moving forward. So we'll go ahead and see. That's pretty much what I'm doing to monitor the dollar direction. Here too as well. So you can see that the dollar had a little bit of a fade off of this 99.5 level of resistance. There's a good chance here that if you do find yourself back at this 200-day moving average or so, or this $98 handle, then perhaps the momentum continues to the upside. As of now, looking at this chart from a daily perspective, you can see that we're in a clear uptrend here. So you don't want to fight that, right? Especially if you have higher inflation prospects in the US. So it sounds counterintuitive that I'm long Aussie dollar, short the dollar right now. Essentially, what I'm doing is two things. For one, the position was speculative in the sense that I was betting on a de-escalation and that safe haven bid from the dollar start to taper off a little bit. So that's one of the reasons why I went long Aussie dollar, short US dollar. It seems like we're getting a little bit of that. So we rejected that 99.5 handle. You have oil obviously trading lower here today. It was at this 77 level of resistance that turned support, in my opinion. So you can see that we broke out here. This was resistance one time, June 24, 2025, right? So we broke out, we traded into this level, we wicked out, and we found support here and are trading to the upside. So we had some decline in oil prices. So that should make the dollar safe haven appeal a little bit less needed, right? And so that's why I went long Aussie US dollar. Another reason, though, when you're trading currencies, it's very relative to the other currency that you're trading with, hence name currency pair you're trading two at a time. So if I just go to the edge finder here and why I think the trade still makes sense, you can see that this is the Eco Surprise Index, basically showing what the recent data releases that affects or how good or bad it is for the currency. You can see that US dollar is doing pretty well at 67% there. But then you also have the Australian dollar at an 83%, very strong, right? You can clearly see that. And so if I just go ahead and illustrate this here, let me go ahead and just isolate. Let's go ahead and isolate the two currencies here. Give me one sec. Oops, didn't mean to do that. My screen's not going down. Goodness, it's my fault. Okay, let's go ahead and just isolate the two, whatever. And then they're both blue here, but the darker blue is the Aussie dollar. So at one point, the US was doing pretty well, right? From February 25 all the way until March 2nd, which March 2nd, March 4th is when the actual escalation happened, when the initial strikes happened, when you got that initial pop in oil. That was the very beginning of March, that first weekend right there. So you can see that the cross between the two, the Aussie and the US dollar, actually flipped. So the Aussie dollar during this whole time, the Aussie dollar is a very risk-on currency, right? Has been doing pretty well in this whole risk-off environment. So that's why I think that relative strength, you also have a lot of other factors too when it comes to the Aussie dollar specifically. I went over this yesterday, COT report, right? So institutional buys and sells, Aussie dollar was at the top of that list. I love to see that, right? Another thing that they're fighting with, similar to what we could be fighting with, is inflation, elevated inflation prospects, right? So, well, for them, it's not really a prospect; it's a reality. CPI for Australia, right? Let's go ahead and flip that over there. You do have, this is the interest rate, my fault. Inflation data, CPI for Australia. We'll go ahead and show that here. 4 consecutive elevated inflation prints of 3.8%. So they're looking to hike rates. And there's actually going to be a meeting next week for that, right? So you do have that. And then also, too, what I really like, whenever I'm placing trades, I'm very conscious of this. Not only do I like to, obviously, who wouldn't want to profit from the trades? I like to profit from the trades, but I also like to collect income from the trades. And so I'm long Aussie Swiss, Aussie CAD, Aussie US dollar. Aussie dollar, I'm getting 10 basis points. Aussie CAD, I'm getting 1.6%. And Aussie Swiss, I'm getting 3.85%. So, collectively, the raw spread, or not the raw spread, the raw carry that I collect for every single day holding that trade long is 5.52%, which is a very healthy amount here. So, as this thing continues, if it continues and I continue to add size to the trade, then that only gets better as far as, the amount of interest that I collect for being in the trade. So, basically, my thought process here with the Australian dollar long position that I have. Also, too, from a technical perspective, how I plan to manage the trade here. Seems like we are getting that little breakout that I was looking for as far as the Aussie dollar. We got there last night. I was monitoring the position, and we've been pretty strong here, holding up, considering all things considered. So if you get a good break above and retest of the situation, then I would like to go ahead and trail the stops here and just lock in a solidified profit against all of the currency pairs that I have. So it looks very similar here to Aussie CAD, Aussie Swiss here. You're pretty much getting that breakout there. So these take profit levels that I have here, they're just illustrative purposes. All the trades were 1-to-1, but I did move the take profit levels here a little bit as this thing has the potential to run up. But that's basically how I'm going to manage the trade. Someone said in the comments, do you think this G7 oil release will affect price? It's like putting a band-aid on a gunshot wound, right? So if you see this thing prolonged for an extended period of time, right, I think, in my opinion, oil above, let's just call it 85. Oil above 85 for 1, 2, 3 months is going to override the potential surplus of supply or artificial boost of supply that the G7 committee was going to go ahead and put in the market, right? So that's one thing. The G7 release of all the oil really only buys us time, and a limited amount of time, if that. A lot of reasons why. The dollar is doing pretty well here, and some countries are doing better than others in this whole thing, right? It's very, very specific, but with the dollar, right, specifically the U.S., they're for the most part more energy self-reliant than other countries, right? They're also from a military attack standpoint, they're isolated. We have the strongest, or you can argue that we have the strongest military. So that's why people kind of flock to currencies like the dollar at the moment. You have the Eurozone, which is more reliant to the Strait than we are, right? And so that's why you're seeing that being affected negatively for the euro. Also, too, you have that stagnation risk. You have some growth concerns there. So although they will get some elevated inflation and may have to hike rates per se, that doesn't mean that it's strong for the euro dollar because you're having high interest rates, but then you're also having weakening growth there too. So it's like deteriorating that market there. So there's some nuances to how you navigate currencies, but the most important thing is if you're trying to navigate this market, low size, wide stops, and then just understand the actual like effects each currency has and the role that each currency plays too. Because you have your risk on currencies, your risk off currencies, you have your commodity currencies, you have your high beta currencies, you have your currencies that are very sensitive to regions, right? If they're region close or close in proximity, that also affects the currency as well. So there's a lot of things you have to consider. Opinion on the yen index. And yen index is hard to trade. I have an alert at 160. I'm looking to go ahead and probably participate in the possibility of an intervention. But at the moment, we're not there yet, so I can't really act on anything. The yen, the yen is battling a couple things. Elevated inflation, they're trying to fight that by hiking rates, but then you have a prime minister that was just elected. She's a fiscal dove, and she does not want that. So you have a little bit of a battle between the two. I think there's better opportunities at the moment than trying to play the yen crosses. You do have the risk of, if this thing gets elevated too quickly, there's an intervention. But again, I'm really, to be honest with you, I'm not putting too much attention on the yen crosses at all. So when I went long the Aussie basket, I was very specific in my choices. I went Aussie dollar long because I'm trying to fade any US dollar safe haven weakness if you do get a decline in oil prices. I went Aussie CAD because the Canadian dollar is somewhat correlated to oil. If oil does well, the Canadian dollar does well. If oil does bad, the Canadian dollar weakens. And then I went Aussie Swiss long because when that Swiss basket has been pretty weak as a whole, I like that carry trade. It's getting the heaviest positive carry out of everything here, 3.85%. If I go and look at the Eco Surprise Index here, the Swiss basket, at one point it was at 0%, but it's been very weak for a very long time. One more thing too, the Swiss National Bank did say, as dollar Swiss was trading very, very low. Here, I'll show you real quick. Dollar Swiss was trading very, very low here at this level. They did say that they do want to go ahead and look at the idea of intervening to weaken that Swiss franc because they don't like that. So that was another added layer to the already weakening Swiss basket. Hey, Marco.
Hello.
What's up, man? How are you?
I'm doing pretty well. How are you today? I know you have a lot of Aussie long positions.
Yeah, I have 3 of them, and they're doing
Cool.
okay as of now. So the relative strength is still holding up there. You do have next week. I forget what day exactly, but next week there is going to be a meeting with the RBA where they discuss rates. Also, too, I don't know if you've seen this, but there was a little bit of comments, chit chatter, with Trump about the possibility of a de-escalation in the Middle East, hopefully. And so, if that does start to have some follow through, then maybe we get some lower oil prices and pricing out of that elevated inflation risk that we were seeing a little bit.
Yeah. So can you bring back financial juice?
Yeah.
So I saw the news about the practically nothing left to target in Iran. So war with Iran will end soon. This is from today. Wow, this is okay. I missed this. This is pretty good. I mean,
yeah, it just happened. I will say, Marco, you were pretty on the ball with that as well. You did say, we had conversations prior, but you also made some videos about it. But essentially, there's a couple ways that Trump can claim victory, and one of the ways that you've spoken about was basically him taking the angle of, we bombed them. There's nothing left to bomb. We kind of won, and you can pull out now.
Yeah, essentially, like because there were no clear objectives at the start of the conflict. I mean, there were some rumors for a regime change, but it was all pretty vague. That pretty much means that Trump can come in at any point in time and declare victory with what they have done so far. Looks like it's headed that way. We had some news about it on Monday, I believe, on Monday, and now again today on Wednesday. So looks like this thing is probably going to end either this week or maybe the next week. And we're going to, of course, massively shift to a risk on scenario. So my position on the Aussie dollar is doing pretty well. I entered at 0.7037, stop loss 0.693. I took 50% off at 7121, and I'm letting the rest run. So if we get another possible break and retest, and if the conflict actually ends, I'll be looking to add in to my positions. So I got a bit, you could say, scared. So I took 50% off because we were approaching this resistance level. But now we seem to have cleared it. And if we can get a sort of a definite end of the conflict and a bit of a pullback back to this level of support, then it's game on to add in more size. How did you spread your risk on the positions? I think you have 3 positions. So did you go like 1% on every position, or?
Yeah, I went I went 1 lot each position, or I went 1 lot 2 and half a lot on another.
Okay.
And I'm thinking the same way as well with you, as far as how to manage the trade and potentially increasing my size on that trade. I agree with the environment that you're looking for, right? It's very specific, but if you get a resolution for sure, and then you get that momentum to the upside, then I would think it would make sense to go ahead and add the position. But as of now, like, right, the thing I'm worried about, and one thing I'm considering, and I'm most likely going to lean this way here, but I will most likely take my profit if you don't see a clear resolution by Friday, because I don't want to go into the weekend with that up in the air. There's a risk to, as you said, Trump has already said that the thing's going to end soon 2 times already. If the more he says that, and the less action, or the less likely that is, like if the actions say otherwise, like there's still bombing, there's still landmines, there's still this and this and that, then his word holds a little bit less weight. And so maybe the markets call bluff, and then, they kind of start, continuing that with that risk off trading there. Yeah, if we can get a break above and retest there, and this thing goes away, then yes, adding at this level, at these highs, would make sense because you have that momentum continuation play. However, if you don't see that, then there is a risk that this thing comes back, and of course, this thing wouldn't be as strong as it would.
Yeah, absolutely. Did you trail yet, or just leaving it alone for now?
Nope, just letting him breathe for now.
Okay, cool. Yeah, I mean, Aussie dollar just looks so good. and the relative strength of the Aussie compared to the dollar and pretty much compared to everything else out there is looking really, really healthy. So do you have anything else on the radar for today, or are you pretty happy with your current exposure?
I have a fail safe or the
Okay.
other angle, which is I was watching the dollar index for direction, and of course, if you start to see the dollar creep up here and the Aussie long basket not being as strong, you would say, then I was looking for a potential re-entering of the euro dollar short or the pound dollar short. I like the pound dollar. Let's see which one of the two. I would probably go euro dollar short, just because the price action, if you compare them side by side, is a little bit weaker on the euro. I would have to do more homework to be a little bit more selective. But that's basically what I was doing was basically prepping for another potential wave of dollar index strength. So you were trading lower on the dollar index. We were kind of getting close to that 200-day moving average. But from a technical scope here, this could have been easily this still could be easily a pullback, and you find some support, you find some buyers, and you just continue upwards as well. So if we start to see that for sure, then I think I would just re-enter euro dollar short like I did earlier this year, a couple weeks ago.
Cool. Yeah, I made a post about the current situation yesterday in the A1 Discord. And pretty much yesterday, the situation was the markets were pretty fairly priced. Oil was higher than before the conflict, but not above the 100 level. And at that point, we needed a new catalyst for the markets, either a de-escalation or a complete end of the conflict, or unfortunately an escalation. So it looks like today it's headed more into de-escalation, with Trump saying more and more, no more targets, the war will end soon, we don't have anything else to do there except maybe protect the ships. And Iran is supposed to be laying out mines in the Strait of Hormuz, but how are they laying out mines if their whole navy is destroyed? That's something I don't understand. But anyways, looks like it's headed for a de-escalation, which is good for our current positions with the Aussie going higher. And what I am looking to do is I do want to buy gold. So gold, if I bring it up right here, by the way, before I bring up gold, if you guys want to participate in the DNA funded giveaway, which I will do during my segment, here is the link to fill out the form, put in your information, and you will get entered into a 5K one-phase DNA funded account. If I bring up gold, it is still pretty close to the 20 MA. It still looks pretty good in terms of the price action. There's still a massive uptrend on the daily chart. And if I put it in the top setups, unfortunately, we have a neutral reading. So I would wait for a bullish reading right here. One thing that I do know is I've been doing some reading from the name is Andrew Campbell. He used to work with, I think, Ray Dalio at a hedge fund or something like that. Anyways, a really successful trader. He has a newsletter, and in it, he basically stated, look, oil prices have exploded higher, and people are expecting when the conflict ends, oil prices should go back to the initial level, essentially the level of, let's say, 70, something like that. But that is actually impossible. The reason for that is a lot of infrastructure for oil around Iran and around the Strait of Hormuz has been destroyed. We know about it because we saw the videos on Twitter and we saw the posts on Financial Juice. To rebuild the infrastructure, it's going to take months to maybe even years. So essentially the supply is already damaged. So we shouldn't see a reaction where if the conflict ends, that the oil price will go back to the initial level. It's not physically possible. That is why having some protection for a possible risk off after people realize that the infrastructure has been destroyed, and owning some gold could be a good play for the long term. What do you think about it?
Yeah, I mean, it makes sense. That area, that route is responsible for 20 to 25% of oil supply. I do like the idea of holding gold for the long term. The price, and this is talking from my current situation, maybe not trading gold at these highs, I wouldn't do. My only concern is, or my only where my mind leads me, is if right now gold has been suppressed by higher inflation prospects. If you do get that oil elevated here, and it does start to trickle into the economies, and for example, the dollar, starts to hike rates and things like that, and money flows into the dollar, I think that may also pressure gold. Now, I don't know which one would outpressure the other, whether it be the safe haven appeal of gold or the higher yielding dollar, or the gold does not like higher yielding assets, right? So that is my only thing, is which one will outweigh the other. I don't know. I'm like looking at the gold scorecard here on my screen, and you see some strong things for gold. Like, you see a growth in the U.S. is holding up well. The job market, we did have that really bad NFP there, but we already have higher than wanting inflation in the U.S. And it may go even higher, right? If because the last CPI didn't include none of this, so we'll see next month if how bad this actually really affected the market. So that's my only concern with gold. I think the way to approach it, and this is just like the way I would approach anything, is wait to see a very strong reading on the edge finder. Maybe you match that with some sentiment play. Maybe you match that with some COT data there to back it up as well. I haven't paid attention to the COT data for gold specifically. I may be missing something. Let me see.
You want to go to the latest report?
Is this latest? Let's see.
Yep.
I mean, it was a flat reading pretty much. But yeah, like if you were to see a couple things kind of pointing at gold being more attractive, then I will definitely take that route. But the only thing is like the nuance of this situation, because like in the past, any type of risk like that, gold goes higher. But now you're adding inflation into the equation, and and inflation translate into interest rates, and interest rates translate into yield, and that's like gold's kryptonite, right? One of gold's kryptonite. So that's why I would hesitate on gold. It looks like it's grinding up higher, though. I mean, I can't argue that.
Yeah, it is. It's kind of looking like, again, a risk-on asset more than a safe haven. So that's pretty funny to see.
You said that was it yesterday, and I was comparing the price action to gold to something like I forgot what I was like, maybe Nasdaq or something. But yeah, it was pretty much very correlated to a risk asset.
Yeah, I mean, it looks pretty similar to the Aussie dollar, if I'm not mistaken. Like, the movement has been pretty similar, especially lately. Okay, not with the latest move higher on AU, but before that, we were pretty much correlated with the Aussie dollar.
It was just holding its weight. That's what it was doing. It was just holding on there. So which is good as well, though. If you start to see, like, to your point, if you start to see, obviously gold in this situation has been holding its weight, showing some relative strength, like at least not falling, then maybe there is a catch-up trade to be played. But again, I would just kind of revert to the edge finder and see if I get like a very obvious, or start to see some improving factors for gold.
Yeah. And about the last NFP print, which came out as a big shocker, I think the biggest reason for such a bad print was the snowstorm. I think a lot of businesses were closed down in the last month, if I'm not mistaken, because of the huge storm and because of some other things. So the last NFP print may not have been super reliable. I know it came out pretty awful if I go back. So NFP forecast was 58K, actual number was minus 92. So I think this is not going to start a trend. Like from the traders that I'm watching, their opinion is that this is just one data point, and that this was heavily influenced by the snowstorm and a lot of businesses being shut down. So this is not kind of the start to the bad NFP trend, which should be kind of good for the US economy overall, and also has an impact on the US dollar, because then we Like if the economy is holding up well, we may get less rate cuts. So we're going to have to see about it. But what you mentioned as well, we had the CPI print today, if I'm not mistaken. Let me see. So let's go to this week. Yeah, CPI print pretty much came on the dot. But that print, we can completely ignore it because we had the conflict, US and Iran. So now we have to wait for the next print, which is going to be in of course, April.
So, yeah, that was definitely a big blizzard all in the northeastern part of the U.S. And thankfully I wasn't affected because I was up north, I think, when that was happening in Chicago. But yeah, it was a big thing, and it halted a lot of business activity. I'm actually very interested too to see like how well the job market has been holding up.
Yep. And I also wanted to ask you about the Euro Swiss. So I do have a small position on the Euro Swiss, but essentially it's more of like a feeler position, if you can say that, small risk. The bet is that the SMB, so the Swiss National Bank or the Swiss Central Bank, has been pretty vocal lately about a possible intervention. So if you go to Forex and if we type in SMB, you're going to find posts such as SMB intervention rhetoric, SMB intervention, let's see, SMB seen favoring FX intervention, SMB signals readiness to curb franc strength. So we're pretty close to the 0.9 level. We know that humans love round numbers. Probably the people working at the SMB are looking at the 0.9 level and saying, we kind of don't want Euro Swiss to go below it. We tried to go below it on Monday, couldn't do it. Essentially, we rejected heavily. So I do have a small buy position betting on a possible longer term intervention. But what do you think about it? And I know the SMB is much less likely to do an intervention than, for example, the BOJ. So the edge here is smaller than if I was playing the BOJ intervention.
I mean, you're the price action here. I mean, this is like all-time lows. So, you know, if they're vocalizing that and you're starting to see, or you're continuing to see the price action that they don't want, that they're vocalizing that they don't want, then yeah, maybe this is something I should probably dive into more. The top of my head tells me that you're probably getting some good swaps being in this position, if I'm not mistaken, or at least you're not negative.
Yeah.
Let me see. Euro Swiss. Okay, yeah, you're in 2.15%, which is, you know, yeah, no, that's holding the trade for a long time too wouldn't hurt you, is what I'm trying to say.
Absolutely.
So even if it's a filler position, it's a low size, you can stomach the you know, the drawdown if there is any, and even if there is a prolonged period of drawdown, as long as you end up flat or whatever, then the swap cost will pretty much offset some of that.
Possibly. I do have limited risk, so the stop loss is not super tight, but it's kind of small, on the smaller side, like 95 pips. And I know most people prefer to play this via options. So essentially, with options, they don't have to rely on a stop loss. For example, I can pretty easily get taken out with a spike, and then price goes back. And then maybe the SMB decides to do an intervention. But with options, you have, let's say, 2, 3, 4 months, depending on the option, where the price can do this, and then you get an actual move and you benefit from the move. So that's the downside of using like a regular execution style on just CFDs. But I do think the 0.9 level is a big psychological level, and it should get defended. I mean, humans love round numbers, and probably the people working at the SMB are saying, we have the 0.9, let's not allow the Euro Swiss to go below it. So we're going to have to wait and see.
Yeah, that'd be interesting to see if you know, finding the options activity for something like this. because you're right. You
Yep.
can basically buy call options and you just pay the premium. And if it works in your favor, then you exercise the option and you collect the upside. So definitely makes a lot of sense. Marco, I will leave you to your portion of the segment. I know you have to do the giveaway here for the prop firm challenge.
Yeah. No
One
worries.
thing I will say though, as we go ahead and leave out, or I leave my portion here of the segment, definitely get yourself a copy of the Edge Finder if you want to be very selective and very strategic with your approach to picking currencies, or if currencies are not your cup of tea. You have things like the asset scorecard, all that good stuff for your trading futures, commodities, gold, all that good stuff. It's there for you. I always say if institutions don't have to do all this homework by hand, neither should you. So definitely go ahead and consider getting yourself a copy of the Edge Finder. And also too, if the wallet's a little bit tight, go ahead and at least join the Telegram channel. It is completely free. There's a lot of free value there. So we will be more than happy to go ahead and invite you and have you on the Telegram channel. But with that, I'll leave you, Marco. Fantastic conversation as always. I went a little bit over here, but it's fun.
No
so we'll talk tomorrow, man, and have a good rest of your day.
Yeah, we'll talk tomorrow. We'll talk about the Aussie, and check out the dollar Swiss. I know you looked at it, so maybe there's a trade in there. But see you. Bye.
All right, man. See you.
So let's continue with the stream. If you want to catch the rest of this conversation, definitely join us tomorrow. Let me just see the schedule when we will be streaming. So if we go to the A1 live stream schedule. Okay, so at 10 a.m. Eastern Standard Time is when Alan starts, and I'm on at 10:15. We then have a joint segment. I want to remind you, if you want to participate in the DNA funded giveaway, fill out the form in the comment section. So in the comments of this live stream, I have put the form. Fill it out, and you'll get entered into a DNA funded giveaway. I do have a 5K one phase account. Let me just put the camera a bit lower. Also, if you want to get funded, if you want to expand your trading capital, definitely do check out DNA Funded. This is my personal 25K two-phase account. I have passed the phase one yesterday, I believe. So the start date was the 30th of January, and I passed it on the 10th of March. So made the 10%. This is the new account. Current equity is just around break even. 3 positions open. And by the way, this challenge is purely traded using ChatGPT. So these are not the positions that are in the A1 Discord. These are purely made by ChatGPT, which is an experiment that I'm doing for my YouTube channel. But it's been working out so far. So we're going to have to wait and see how this turns out. So we have a discount code for you. With the code A1 Live, you can get 25% off any DNA funded challenge. So A1 Live, 25% off any challenge. Definitely take a look. You also have the link in the comment section as well. On the watch list for today, I have my Aussie dollar position, which is right now running at 1.3%, something like that. Not percent because I didn't risk the full 1% on this position, and I closed 50% of it, but it's running at around 1.3 reward to risk, you can say. So I'm just looking to trail the position. If the war ends, and it looks like it will, let's just delete this filter, go to Forex. Also, let me see if we have anyone coming on after me. No. Okay. If we look at Forex, you have this practically nothing left to target in Iran. War with Iran will end soon. So if it actually ends, if we actually get a conflict resolution, Aussie dollar should go flying higher. In that case, I would want to add into my position. So I would want to get in on some more long setups. If we can push up a bit more, retest this level, so it is the 0.714 level, I think that's pretty good. Fundamentals, long-term fundamentals are still bullish on the Aussie dollar. I think the Edge Finder is bullish as well. Let's take a look. neutral right now, but it definitely was bullish. What I do know is that the RBA, Central Bank of Australia, is looking to hike rates, while the Fed, Central Bank of the United States, is looking to cut interest rates. That's the perfect storm for this thing to go up. Let me see any sort of a resistance level. Yeah, we have this high as the resistance level, but we already sort of tested it, rejected, and are now pushing through it. So we already sort of tested that level. Let's do the giveaway. Let me grab all of the names. Today is the 11th. Let's take a look on my form. Okay. Copy. Wheel. Paste. Spin. Let's see. JAFC is the winner. So congratulations to you. After my segment, I will send you basically the discount code for the free challenge. So it's a 5K one phase DNA challenge. What do I want to do? Yeah, by the way, if you want to get funded, so this is my personal 25K two-phase account. I'm now in phase 2. But if you want to get funded, use the code A1Live. A1Live for 25% off, just as a reminder. Comments. Let's see the comments. Hey, Marco, quick question here. Isn't it better to buy Aussie Swiss rather than Euro Swiss if we're betting on CHF bank intervention? Or when CHF bank intervenes, it could select currencies to intervene. Well, the Swiss should lose strength across the map. Personally, Aussie Swiss has been flying, so that looks great. It definitely is a good play, but I'm looking at a specific level. So the reason why I like the Euro Swiss is because I can put the stop loss below a significant level, which I think the price will react from. So you have the 0.9 level, and the stop loss is below it. So I'm betting on a sort of a imaginary wall here, imaginary support, and that the S&B is not going to let the price go below this level. So in terms of the stop loss placement, Euro Swiss seemed like a bit of a better idea. Looking back at it, or when I took it on the 6th of March, yes, Aussie Swiss definitely looks good as well. Aussie Swiss had an explosion higher. Let me just see the edge finder. What do we have? The CHF. Very bullish on the edge finder as well. So in hindsight, yes, probably I should have bought some Aussie Swiss as well. But what I really liked is I liked that round number. I liked the 0.9 zone as being a clear no-go zone for the S&B. But again, it's an experimental position. It's small risk, and it's just to test out the markets, to test out the water, because I don't have, if I'm being honest, I don't have a lot of confidence in this position. That is why this was not a signal in the A1 Discord. What was a signal was this position. So this was a signal in the A1 Discord. And if you want to get all of my trades, my best ones, not these experimental ones, let's say, definitely consider joining the A1 Discord and use the code Marco to get 25% off. So I've been on a pretty good winning streak, not to jinx myself, but I've had some pretty good positions in the last few weeks. If you want, join me, check it out. I think you will like it. I think once you see what we have in there, I think you will definitely like it. Leon says, I think there will be one last hurrah before they do end the war, just to stir things up a little bit, possibly. You never know with Trump. He's a pretty volatile guy. Unfortunately, once Trump goes out of office, I think the traders will miss him. He's great for spiking chaos, but he's also great for injecting volatility in the markets. So we're probably going to miss him when he's gone. I think it's going to be a lot more boring without Trump, at least in the markets. And if you're a trader with a lot of experience, you can navigate the markets around Trump and you can make some pretty decent percentage. Like during April 2025, and now unfortunately during this conflict, you know, we had a lot of volatility, a lot of moves, and if you played it right, you could have made some nice trades. Buying Euro Swiss could be more lucrative since overstretched, possibly. Yeah, it's basically the rubber band theory, where the rubber band has been stretched so much to the downside that it may be time for the price to go up. That could be the case. So that's a great point from Sluggy. There's no clear support though. Like there's zero support. So this thing could just keep on going lower, just keep on crushing lower. I personally don't think that the SNB, Swiss Central Bank, is going to allow that to happen. And I can be in this position for weeks. I don't mind it. It's positive swaps. So that's always great. Anyway, we have reached the end of my segment. Only two things on the watch list for today: Aussie dollar and gold. Gold I want to buy, but I'm waiting for a clear bullish reading on the Edge Finder. So I want to get in, but I need the bullish reading from the Edge Finder. Join me in the A1 Discord. Use the code Marco to get 25% off. I will see you tomorrow. So definitely join us tomorrow as well when I'll have another joint stream with Alan. Good luck with everything, and be safe out there. Okay, see you.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.